All right, let's get into some other stuff. This came from one of our students. I left his last name and his email address off. Steve, cannot thank you enough for sharing your insight. Account up 5% this morning, even though I traded with 1/4 of the lot size I usually trade. So times that by 4, you could add a 20% day roughly. I decided to start marking up charts with comments to the brokers. And when I think of them now, I'm going to call my future chart markups. You read it yourself. It's right there. I think it's pretty great. I think Kim, I think she went away, Kim from last night out in California. She has drained the banks or kicked the broker's butt, same type of thing. So if that makes you feel better and you start getting your money back, put it on there, man. It's great stuff. All right, Anna, another one doesn't listen. Here's her non-farm payroll trade from last night, this morning. They set up nice overnight. I took one myself. All right, look. Market makers have been dropping, right? They hit the low. They repeat the low. They repeat the low again. Lights out. A quick 50. In and out. Okay, this was Australian USD. I took it in 2 bars to the water, 30-minute trade. Got out at the watermark. We'll go over it in a second. All right, here's USD Canadian. You have vector right out of the box. 1, 2, 3 to the high, right? A quick pullback. They hit it again, failed to take it. You guys can't see that? Let me see. Let me check this view. Can't see the screen. All right, I'm zooming in all the way. I'm zoomed out. Yep, okay, it's you, man. Sorry. No C, it's you. Rodney, it's you, buddy. Dick, it's you. Okay, good, good. All right, look. You have your vector right above the box, right? Okay, look. They come right back. I want you to notice that little tiny red slash marker right there. That's the stop loss on a script. Okay? One of my favorite things to see is I call it string you out. You get strung out. See the string? When you execute the scripts, it puts the stop loss point and the take profit point roughly on the chart. See it right here in blue? Zen's going to cover this stuff with you guys. And when you run the string, it shows you the entry and the exit where you got in. Sean, no, this is people's modification to my charts, man. If you want to use it, it's okay. He's asking about those dots. That was written by another dude, the rumpled one. I can't think of his name, TRO or something like that. He's a good guy, man. He's a good coder. You use what you want to use. I told you, I'm not so full of myself that you have to use my stuff. If it helps you see it, it's okay. But understand that this stuff is clutter, and if you don't know how to use it, it's just going to confuse you. You're looking for M's and W's. How much simpler can it get? At the appropriate time ribbon next to the averages. Right? Yes, Ray, they only show the swing highs and lows. They don't indicate anything. And they move. When the high changes, the dots move. It's not like, oh my gosh, that dot painted on the high. If we had that, the class would have been over on the first day. I gave you the indicator and left. All right? Okay. So anyway, there's our entry. She's strung out in 50 pips. Beautiful. Fantastic trade, Anna. I know you don't listen anyway, so I had to show it. Okay, look, here's Australian setting up. Same thing. It came down like this. It hit it again. Re-evaluate the box, right? Drag the box, stop hunt low, vector, 1, 2, 3. Hammers issued off of the low, the appropriate time. Enter. I took take profit right here at the watermark. In and out. Okay, let me zoom this a little bit. You might be having trouble seeing it. I am too. Okay? Hopefully you can see that. I'll go even bigger. How about 400%? Yeah, there you go. All right, look. Here's your pen. Market makers come in, bam, set the low. Trade off the low for a little while. Right out, reevaluate your box going into the open. Spike to the low. First target's the water. 2 candles, 30-minute trade. You're out. Okay? Beautiful. Okay, same thing appeared in euro. You blow it up. Same exact setup. They've been dropping for a couple of days. An aggressive move to the low. They came in. They hit it. Pulled back. Reevaluate the box. Going into the session. You have vector to the bottom. Right at the appropriate time. Here's the entry right here. And in one bar, they shift the zone. It's a 30-minute trade. They went into consolidation. I was up 50 pips. My target was here. I was projecting for here. I missed. So it went into consolidation. I just took. I wanted to go to bed. It was getting close to news time. I don't trade the news, contrary to my students. I heard that somewhere before. You shouldn't do it, but who listens, right? I just took it off and went to sleep. It was getting late for me. All right. Trade was up 35 pips or so. Move stop to break even. Adjusted it. When it went into consolidation, I was looking for my take. I thought this candle was going to make the reach. It just missed. I thought the next one would close up and hit the mayonnaise. I didn't get it. Be happy that I got 50-odd pips in 45 minutes or so and just call it a day, man. Don't drive yourself crazy. The trade is over. The trade is over when the pair goes back into consolidation. Okay, now, this is probably level 1. It is level 1 consolidation because it went on to do this, but you're not supposed to be in during the news. So here. Okay, this was my projection coming in. Pull back. Here's my projection. I strung myself out right here. I got strung out. 50-odd pips. Australian limited up. Right back to the water. Piece of cake. This would have been right to the water in one bar, and it would have been over in 15 minutes. I just felt like Euro had a better bottom on it, and I wanted to try to grab. They were working the Euro crosses. EuroCAD was in play. Euro CHF. I figured I would get more out of it because they were working the crosses. And I just missed my TP. I projected my average where it would go. I anticipated this is the TP. If I got a nice clean break and a pullback, I was going to hold for here. But it started getting close to news, and I was tired. Okay? What does strung out mean? Is when this little string, you get taken out. That little string, I love that. Some of my slides I showed you in presentation with multiple scale ends, you get like 15, 20 strings running down and all hitting to take profit. It's a beautiful thing. I love it. It's not, no, I'm not on heroin. All right, kidding. All right, good stuff, man. This was, look, non-farm payroll. If you're new to my class and you thought I was crazy, I told you news is used to complete the patterns. If I was an attorney and the class was over, I would post this up and say the defense rests. It's over. All right, can everybody see that? See my screen? Let me shrink it a little bit. All right, there you go. Better. Okay, look what we got, man. Trade both ways. Here. No problem. Someone sent me a chart. It was absolutely a beautiful markup, CHF. They hit it again. They shorted. They hit their take profit. Session changeover right in here. It's funny how they issued that second leg right after the news and changeover. It's actually amazing. Think about how crazy that is. Trade entries here. Stop losses here. The trade is painless. You got 4 bars to profit. 1 hour straight rise. Remember you said, oh, the stop loss. You're going to learn quickly that when you catch second leg M or W formation, the stop loss becomes irrelevant. It's there as a safety measure. In case for some crazy reason you didn't catch the second leg. Okay, I promise you this stuff is going to start happening for you. A lot of people are sending me emails. Up 5%, up 25%, 100 pips booked, 200 pips booked. The news is used to complete the patterns. Somebody, Maria, actually. Nice to see you, Maria. 120 pips in 4 hours. Or on the 4-hour chart. Beautiful setup. Fantastic. Very, very good stuff, man. Very excited for all of you. Like I said, the journey does not end today. It begins. Okay, so everybody see that? How beautiful that is? The anticipation for the news is they've been dropping. Stop hunt low, trap the traders, shoulder, head. See it? Shoulder comes out at London Open. Game over. Okay, same exact pattern. GC, GBP, it's everywhere, man. Nick, fantastic, man. 120 pips on Euro GBP. James, 198 pips. You guys are amazing, man. Absolutely amazing. I couldn't be more proud of all of you. Okay, good stuff. See? You took a chance on me, and I'm not a nut, am I? It's in there. It's in there every day, my friends. Just got to lay in wait for the dealer to show his hand. When that MFer shows his hands, you kill him. Kill that guy. Bruno, 4 out of 5, 100 pips. Fantastic, man. All right, I got some sad news over here. This is my last Diet Coke. I sent Heidi to the store on an emergency run. I miscalculated my Diet Cokes for the class. I know, Jim. Crazy. I know. I'm trying to quit. I promise I am. Asubio, I know. All right, look. This is the next thing I want to talk about for you guys. I want you guys to come to the live class. If you weren't sure before and now you've changed your mind and maybe I'm not so crazy, this is what I'd like to do. I know there's some people that offered that live in the area. I'm going to ask Kanan sometime in the next few minutes to put Dallas or Bust on the forum to make a category, make it sticky to the top. What I'd like to do is start some camaraderie between the troops. We did it in New Jersey, and it was fantastic. Okay? No link for Greyhound, man. What I want to do is maybe some people live in the area. Maybe some people are doing better than others financially. Maybe you've been more fortunate. Maybe you've been around longer. You're doing better. Maybe you can room together with some people. Maybe you can share hotel space, help each other out with a meal. There's a lot of people that started writing me that want to come to Dallas, but because of the economy and because they found me so late in their trading career, their accounts are low, and they don't have the money. I feel bad about that. I want you guys to come. Everyone that wants to be there has a seat. I'm absolutely going to see to it. What we did in New York was we did it on a university, and there was dorm rooms. And, man, there was 4, 5, 6 guys in a dorm room, 3, 4 girls in the dorm room. It was really cool. So what I'd like to do is possibly, if you live in Dallas area, if you're more fortunate than somebody else, if you have a trading partner or a buddy, why not offer a hotel stay for them? Why not offer some space in your home? Why not put your cat in the garage and let them sleep in the cat's room? Okay, let's build some camaraderie. Let's all get together, because I'm going to tell you that outside of this room and this family, people are going to tell you that I am a psycho, man. They're going to tell you I'm a nutcase. But by day 4, you know better now. So you telling someone that 8 out of 10 is possible, and that 100, 150 pips a day, and there's a guy that booked 1 million pips, and there's a guy that's making 100 grand a day is possible, they are going to think you're part of the same drug that I'm on. Okay? If you live in Norway and can't make it, I understand. But if you can make it, you got a spot here, buddy. Come on, there's a seat for you. Yes, I'm high on pips. All right, so Kanan's going to throw this up in there. And if you live in Dallas and maybe the Omni's too expensive, maybe down the road is a Holiday Inn or a more affordable hotel. If it's $60 a night or $40 a night, and there's a tram to ride you down there, or if we can work some stuff out, I want you guys to get there. If you thought, hey, I'll throw some money at this guy and take a shot and see, and now you've changed your mind about me and you want to come, if you want to come, I want you to be there. Let's get together. Let's figure it out. Okay? Joe said he has space for 3 or 4 women in his door room. Let's keep it guys and girls. Sorry, Joe. It was a nice swing and a miss, buddy. That was pretty good, though. I like it. If you've been around me a while and you're making money and you're more fortunate, help somebody else. Stick your hand out and pay it forward, my friend. Okay, that's what I'm asking. Dura, 240 pips, scaling in on GCAD. Fantastic. Vector setup, beautiful, beautiful. You're in Dubai. Come over. I like Dubai. I might make it out there one day. Okay, look. The Omni's 83 a night is what people are saying, but we're trying to see if we can get a guaranteed lock-in rate for that time of year, because it's after the summer, the rates go back up. We're trying to work it out. But you know what? If you can throw some gas in your car and find a place to stay and get down there, you have a seat, man. All right? You haven't lived till you see me live. Yeah, right. My wife's flipping me off. All right, man. I'm just kidding, man. Okay. I hope to see all of you there. I hope that I've opened your eyes to some crazy things in the business, and that you feel differently about the knowledge, and that you should feel relaxed and calm and empowered. Antonio, I'm not going to do this forever. Right now I'm enjoying myself. As soon as it's not fun anymore, it's over. Okay. I'm so proud of all of you. I'm so happy to see this stuff. But let's get on with the class business tonight. We're going to talk immediately. We're going to go into fractional disparity. If Scott is ready, I'm going to turn the screen over of control to him. He's going to talk to you about how he looks at the crosses and his last year and a half where he almost cut his ear off. He's going to talk to you about that and his quest for knowledge and how he figured out how to master the high and low. The trade I posted up there where I grabbed Australian within the tick, Scott has become a master at that, and I couldn't be more proud of him. And this is his way of paying it forward, man. So, Scott, if you're ready, and you can take over the screen, you have some slides. I don't know if you need that, whatever. Thank you, Albert. All right. So I'm going to give it over to Scott, and I'll let him talk about disparity for a few minutes, half hour or so, and then we'll move forward through the slides. We don't have a lot to cover. Tonight, the agenda is going to be Scott for a little bit, myself, and we're going to wrap it up with Zen and his wife. I don't know if she's up to it, if they found a babysitter. If not, it'll be Zen. He's going to talk exactly what they do for the checkdowns and how they go through their setup and looking for opportunity in the U.S. session. I know Deb hates to get up early. She's a U.S. trader. There's quite a few. Natalie, a couple people in the group don't like the London, so they've taken my method and nuanced it to fit them for the New York session. Okay? All right, Scott. Okay, you're coming off mute. Somebody hand control over to Scott, the screen, and Kanan, if you can get that stuff up on the board for me, that Dallas or bust, and I'll be back in a few minutes. Scott, it's yours.
All right, good evening, everyone. I guess I don't know if I'm seeing the chat or not. Just pick some yeses in, see if I'm projecting. If you guys are looking at my screen, I don't see if I am or not. So, are you just seeing my desktop, or are you seeing my platform?
Scott, no platform. It's coming in now. Yeah, there's a thing that shows audience view. If you open that dashboard, you'll see what they see. Right under by attendees.
Okay, so audience. You guys see my platform here then?
Yes, we're good now.
Okay, so really the most important thing that I learned, so all right, I guess the way to premise this is to quickly describe how I came to know Steve. I met him beginning of last year at the other venue, the old place, and the old venue chopped classes up into parts 1 and part 2, and I'd taken part 1 and it was a joke. And so I didn't attend. I didn't know nothing about Steve. The only thing I'd heard about this guy at the time was from another friend who said, he's different. I said, okay, that is nice. That could mean absolutely anything, right? She failed to qualify just how different he is, just how far removed he is from all the garbage that I had previously spent a lot of time searching like everyone else on the knowledge quest in vain to try and figure out what the hell's going on. So yeah, it was a fun couple days. I mistakenly and foolishly and perhaps arrogantly and misguidedly missed the first 2 days when Steve just poured straight into all the material and started going over stuff, including fractional disparity. And so I just, apologetically came in and said, I had no idea. I'm sorry. Is there any way that you could just quickly go over the material quickly again? I know I missed it, but God bless it, I wish I'd been here if I'd only known. Someone just said you were different. That did not mean anything to me. So he just gave me this look like, really? Really? You missed 16 hours. I'm not going to go over this for you. So I felt incredibly bad. But so anyway, the next 4 days really switched everything. It was an evening class. The state I was in at the time, I was applying for jobs at the exchanges and different prop firms just to learn the business from the inside, and was actually going through the interview rounds at one of the major futures exchanges and to be an investigator, which would have been cool, but it was basically like on the mindset, all right, I need to, hell or high water, do something. I don't have time to take this class, actually, so I had the wrong attitude going in. But suffice to say, everything changed that day. It really did. The next day we started hitting it. I met Carr, I met the other guys, I met some other individuals who I'm still really good friends with. And so all that is the backstory to explain what we came here to listen to me speak tonight, which is a concept which he explained that all of a sudden clicked everything together, right? So what he's been talking about is looking for a pattern in one chart in one pair. Now, most people look at a chart and they try and describe what it is that they see. They have, in absence of knowing the true knowledge of what it is, people's minds concoct all kinds of ridiculous descriptors to say, all right, what the heck it is that I'm looking at. All the things that he chides and makes fun of, all the rally bases and flags and pennants and wedges and everything that is forming a picture based on the absence of knowledge of what it really is. And when he explained that you can't really look at a chart, one pair in isolation, that there's much more going on, that in order to make movement in one pair, they have to work the other ones. And then when he just said it, I was like, I never thought about it, because you can't find that, because if you look up, I guess someone from the last class tried to punch in Google fractional disparity, and I guess it comes up with some ocular garbage. Anyway, this concept is little known. It is not correlation. Let's say that from the forefront. It is different from correlation. All right, this is not correlation. This is what is truly happening to drive the movement in the pairs. And the simplest way to describe it, and bless him, he had tried and had a number of different ways to try and convey this concept. It's really just get it in your head, the concept of what's happening, and then it starts to click, and then you start to see it. And so one question to ask is it imperative that you know this to be able to trade successfully? No. Does it help? Yes. Is it the most important thing? No. But putting it in context of what Steve has been going over the whole week, it is immensely valuable. Right? And so what it really boils down to, I'll try and say this is, let's try and explain it in a way that hopefully gets across the concept. And the simplest way to understand it is understand that when people talk about dollar strength and dollar weakness, and the people are flooding into the dollars because there's risk appetite or risk aversion, that's them looking at a chart, seeing it go up and down, and coming up with a story that has nothing to do with what's actually going on. And so now when you hear these people say that kind of stuff, you can kind of chuckle to yourself, because when I explain this to you, it's just going to start clicking. All right, and it started clicking for me, and that's why I kind of ran with it. And so that's when Steve said, I guess, a little worried I was going to cut off my ear because I might have taken it too far, too in depth. But what essentially is happening every day, every pair around the world, there's the speculators and then there's the commercial interests, and so there's the volume flooding in and out of every pair all the time. And so the banks look at this and try and decide where's the volume. All right, Steve said it's all about the money. It has nothing else to do. That's all there is to it. So the guys at the bank desk can look at the pairs and they see the volume that's stacked up at different price pairs, right? At every price, there's a certain amount of volume in every pair, okay? So the euro's the most heavily traded, and the yen's the second most heavily traded. So let's say on any given day, the guy walks in and he'll look at his book, his internal book, and he'll see that, all right, there's about 20 billion committed long in euro-dollar spread across, these 50 pips, right? So he's going to know that I gotta slide straight through those 50 pips to pick up all those orders, right? So he's going to start buying up euros. So euro is going to increase relative to the dollar, right? This is 101 stuff, but just bear with me. At the same time, he's got his other guy who's sitting right next to him, who's also looking at the yen pairs, right, to understand that the dollar yen has got, let's say, 18 billion. These are just arbitrary numbers, but these are relative volumes that you'll find in spot, right? So when that happens, at the same time, you'll see euro rising and yen rising. Now, everyone that says dollar strength and weakness, they're full of baloney, because that doesn't make sense fractionally. There's no fractional disparity, all right? So what you'll see is that in order to create movement, they'll look at the majors, right? In this case, euro dollar and dollar yen, and then they'll also look at the volume that's built up in euro yen. So let's say there's only 600 million that's spread up across euro yen. it's going to make more sense for them to hold the level. All they have to do is just soak up all the bids or hit all the asks in yen to hold the price at that level, right? So everyone that wants to get out, they can't. You see the trap move stuck, trap move stuck, trap move stuck. Price is not going to go below that level. It's not going to go below that level because there's volume that makes sense for them not to allow it to get below that level. So while that's occurring, they'll hop over to euro yen and start driving that pair up by soaking it all up and creating enormous spikes. So what you'll see, so the reason they do that is because it's cost effective. This is the largest business. It's cost effective, right? If you could spend 20 billion to move a pair, or 18 billion to move a pair, or 600 million, 1/20th, to get the same return, what would you do, right? This makes sense now, okay? So understand that when you see euro rising and dollar yen also rising, what's actually happening is that the cross pair is comprised of the two majors. So when you have euro plus euro minus dollar and dollar plus dollar minus yen, what's actually happening is the combination of them, understand, is that euro is rising while yen's also dropping because the dollars are canceled out, right? So you have minus dollars plus dollars. So how to understand this, if that makes sense intellectually, now that you get the concept, okay? So they'll hold one pair, okay? Use half of that pair, use all the cross pairs of that, right? So they're holding yen, they'll use all the other yens to start driving those up. That's going to create movement in the other major. Make sense? I can't tell. Where's the chat? Let me see. I'm just going to assume it all makes sense. Yep, I'm getting yeses. All right. Some yes, some no's. Makes sense to some.
Do you have more? You want to take some questions, or?
I don't have more slides. I was just going to describe in the chart how to recognize what's happening to see.
Absolutely. Yeah. Keep going.
Yeah, it's obvious, right? It's coming into focus about what's actually happening. It's making sense. It's not making sense. It's just a concept. Okay. Can you explain but slower? Slow down, the same thing but slower. What's really happening? I'll just say it again and see if I can just simplify it in the simplest, like distill it to its bare essence. Whenever you see a pair rising nicely, let's say euro, and you look over at the cross pair and it's going back and forth, hitting, there's wicks both sides, pound yen or pound Swiss, notorious for this. Understand what's happening. Okay, just think about both halves of the whole, both halves of the pair. If you have pound and Swiss, they'll run up pound Swiss, hit those numbers. That will, kind of pull up pound a little. They'll hit Swiss down. That'll drive Swiss down a little, right? So they're whipping it back and forth, inducing volume. As soon as they have it trapped, they'll work the other pair. Okay? So when you see choppiness, it's not, there's confusion or congestion or volatility or any of the other nonsense descriptors that you probably have floating in your head and will find even on the newswires, Dow Jones, CNBC. That's not what's happening, and as soon as and when it's not the major, it's the cross, and so when it's not the cross, it's the major. It flows from one to the next. And when Steve had that chart with the grid where the euro pound laid out with the yens on one level, the Swiss is on another level, and the majors on the top level, if you arrange it like that and just watch it, and see, and just think to yourself, oh, okay, so they just hit the high in pound, and they just hit the low in euro pound. What does that mean? Right? So when euro pound is dropping, think about it, pound is rising, and euro may be holding. So look over on the euro dollar and the pound dollar and see what the case is. If it's hitting the highs, as a stop hunt. Okay, while you're seeing euro pound hit the lows, you know what's coming because they're trapping it in the crossbear, and it will lag from one to the next. And so if you hopped into euro and let's say you see it just hit the M and it's gone and you miss it, do not despair. Often you can look over at the crossbears and see that they'll be forming up 1 or 2 bars later, because after they've worked one pair, right, all the volume is trapped on that pair. They'll slide over and work another pair, right? As soon as you got some guy stuck and you drive price down, no matter, you can just have it sit there and the guy's looking at a negative balance. And let's say you hit it to the high and pull it back, then the guy who went long is showing a negative balance. You hit the low and pull it back, the guy that went short showing a negative balance. You just hold it in the middle, right? So anytime you see chop and it's sitting in the middle, you know that there's longs that are showing open float negative and shorts that are showing open float negative, and they're both screwed. So look to the major that's causing that to occur, and you'll know which direction to take the trade. Some of the questions are, yeah, you're asking too many, you're flying by. Can I increase this? All right, people saying it's starting to become clear. Sorry, just give me a second to read some of these questions. Always 15 minutes, yes. No charts, you guys want charts. Yeah, all right, so I've just understand it in your mind about what's happening. If you look at a chart, you're going to be slightly confused because it's a deliberate obfuscation, right? It's intentionally hidden. How long have you been looking at a chart and you couldn't piece it together? It's not really there. You have to discern what's actually happening to be able to see it. And once it is, as he says, those like magic things where you develop a sense for being able to watch this and see it. All right? God, you guys are all kinds of, how do you discern? To discern it means to be able to pick out which way the pair is going to move next based on looking at the other pairs. So stop thinking about a pair in isolation and understand that it is being worked in context of the other pairs. Yes, Jerry. Are you saying that if the crosspair is not moving, look to the major to get the direction, and then you can trade the cross in that direction? If you see the pound is about to rise hard, look at the pound cross pairs, and you may be good to go, because the pound will drive the cross pairs, so to speak. So, you know, if you maybe want to spread your risk, if you're a one lot trader, put half into euro and half into euro yen. And then depending on what yen is doing, you'll get more movement or not. How do you develop the ability to discern it? I stared at the charts for way too long. But with a fresh set of eyes and new knowledge. Now knowing what we know, and so Steve gave this core information about what fractional disparity really is. Now knowing that there is a seed of truth of what's going on, I went out and actually had the luxury of speaking with some bank traders. A guy at PNB Paribas explained, you know, here's how they actually do it cost effectively. It's about the cross pairs are worked because it's cheaper, and that just makes sense. And they look at where the volume is. Then it's just they're constantly hedging at every price point. Right? There's a point on every chart where it makes sense for them to drive price, because that's where they're going to walk off their money. Yeah, working the pair, right? It means running the bursts and the stop hunts, then creating the HOD, LOD. Yeah, working it is you'll see whipsaw, back and forth, choppiness, whichever way to describe it. You know, quote volatility, erratic. It's not erratic, it's purely designed, right? It's intentionally moved exactly that way. Charts. You want charts. All right, so here's what's going on in pound today. Here's what's going on in euro. They look similar, right? This stuff need to be seen in real time to really pick it out. And setting up the grid that Steve did, that just made it like, if you just look at it, you don't see why that it's set up that way. But now you add the knowledge of this, and it says, oh, okay, that makes perfect sense to set them up like that, because you set it up as a grid. Okay, I've since gotten rid of it because I got more monitors, but essentially, if you're looking at euro and you're also looking at pound, have a look at what's going on in euro pound to see if they're hitting the high or hitting the low. And in real time, you'll see, okay, all of a sudden euro pound takes off and euro is not moving at all. Then you know that the movement's in pound. Now, right? Let's say you're looking at dollar yen, and they intervene, and you're looking at euro dollar, and it's like, all right, that's kind of moving. Then euro yen, right, is either going to be helped or hindered by what's going on over in euro. So when they're acting in concert, right? So a lot of the time it is like the dollar bases are rising while the, if euro dollar is going up, dollar CAD may be going down. And that's when people say the correlation and all that nonsense. It's not always the case. In fact, it's very often not the case. And this is the reason why. That just did it for me. Thanks. I'm not sure what exactly I said, but any of the crosspairs, you need to just see that whichever crosspair you're looking at, look at that crosspair, and then look at the two majors that comprise it. Is there a way to figure out if one leads first? Yes. Watch how it moves. If it hits the high and starts dropping, that's the one that's moving first. Alright, so if euro yen hit the high and is dropping while euro dollar is still sitting at the high, then you know that euro yen was first and that euro is lagging. Does that help, Whitney? How far back in the charts do you look? Live? I don't really do analysis homework-wise. I mean, I did a great deal back in the day, which I guess helped. So you may want to do that. But it really just came down to just taking a broader view of watching all of the pairs move in concert. Okay, it's being described as a dynamic dance amongst all the pairs. It's really quite beautiful to see. Okay, this is there's really some magic happening once you understand it. There's much more going on behind the scenes that create this chart that you're looking at, right? So, and if that can be imprinted enough into your minds, it's flipping your mind to seeing it as it's being created for you to try and be deceived by looking at it. Okay? Why is the water red? Oh, I've got another random indicator. Don't worry about the indicators. So it's the work of 3 charts move 1 chart, so it's the work of... Yeah, Nick, potentially, yeah. So if you miss it in one, look at the other, and just notice that the crosspairs are what is creating the movement in the majors, and vice versa. And that's why I say it's a intellectual curiosity. It's fantastic to know. It can help you. Do you need to know it? No. Just imagine that all of this knowledge can take a back seat to the pattern, but let him come along for the ride. Because he'll add his insights. All right. So with that being said, the other thing that was explained, the way Steve learned, was before the age of charts. If you want to date him and see how old the guy is, I mean, he looks young at heart, I guess. No, I'm sorry, but He said, listen, the way to do it, and if you ever get the chance to walk around the trade floor of any bank, a lot of them don't really have that many charts, simple charts, not all the silly indicators. What they do have is their book, their internal book. All right. So as soon as they see all the orders that are flowing in to their internal book, and then they look at the customer book and they see what the difference is in how they can work their own internal orders against what the customer orders are to create movement. Okay. So it's an ongoing, ever-changing, perpetually moving, shifting from moving a major or a cross pair. And the times when they really work it is around London. So like there's a necessary thing to note here is don't go too deep into it like I did. That's why Steve was saying he was worried I was going to cut off my ear. There's a sense of trying to pick it too closely. If you can just step back and appreciate how they move the cross pairs to create movement in the majors, I think you'll be well on your way to just understanding it and using that to say, okay, so they're holding your yen right now, and like you see yen's rising, and all of the other yen pairs are rising sans pound yen, then you know pound is being worked the other way. All right, that's how it's going to clue you off what's going on. Last night Steve showed 9 screes. Yeah, Abe, both. I got a monitor that's 9, and I have a monitor that's a big one. It's just one chart, and I flip between them. So it helps to see them blown up, and it helps to see them while you're watching the other pairs being worked. Look at any chart that looks volatile, crappy, choppy, erratic, spikes. What people say is confusion, or what are the? I mean, I don't know. You guys, what are some of the silly terms you guys have heard to describe a chart? 15 minutes, yes, always the 15 minutes. Ugly is congestion. There's a cold, the chest cold. Just wiki. Just rubbish terms. Absolute rubbish. This is what's happening. Like with everything else Steve is saying, it's like what you're looking at isn't actually what you looked at. Whipsaw, that's the one. Whipsaws. It's getting whipsawed. Oh, I got whipsaw. I got a head fake. There's no head fake. There's no whipsaw. There's nothing. It's nothing. There's nothing to do with it. Bag of nails, plain messy. Yeah, it's all garbage. Like take all of those terms that I'm using to try and convey constipated about what it is you're looking at and understand it for what it really is. All right? It has nothing to do with any of that rubbish. Okay, so yeah, I'm sorry, we're getting off track. Head fakes. You playing basketball? The other thing that became really fascinating and to understand where I picked this apart is I guess I have a natural affinity for numbers. I guess just how my mind works. And so some people are visual, some are kinesthetic, some are auditory. What you're looking at in a chart is plenty to make plenty, but it's a cookie crumb trail of where they've been, where the damage has been done. All right? Yeah, thanks to Steve, I never actually needed a job. Didn't need to. Yep, just been trading ever since. I was dead set to actually have to, like, all right, I got to go back and get a job, but pretty soon after the class, it was like, all right, I got to stick my nose to the grindstone and make this work, and started to, So yeah, that's all I've been doing. Had some ups and downs, had some other things happen that affected my trading, but yeah, back on track now. The other thing to really learn that Steve went over is to go over how he learned to trade, which was looking at the high-low board, right? So in MetaTrader, if you guys just see this button here, pull up Market Watch, click on that button, and then watch it. Now, what I do is you can right-click here and say pop-up prices, or just hit F10. All right. If you hit F10, it's going to pull up a pop-out window of all the pairs. And by the way, you can adjust the list if you just show symbols and sets to only have the pairs that you want to look at, so you don't have, like some brokers have, every currency cross under the sun. Now you right-click on it, and the most crucial part, if you don't have this checked, you're doing yourself a grave disservice, as Steve says, and that's to include the high-low. Right? So right-click on this pop-up and say high-low, and I also have time on my other screen. Now I blow this up and I put it on another monitor. I got a little crappy $100 Dell 17-inch on the side that just has this floating all day. Now the markets are closed, so you don't see this moving. But what you will see sometimes, which is not apparent in a chart of 3 moves, it will be hidden within 2 or 4 or 6 candles, because the candles are really just there based on time intervals. But they could hit the high not on the 15-minute markers, although they do use candles in the timings of their moves to create patterns that people play to get them to go the wrong way. But not always, because sometimes the money's just there and they just hit it. So what I watch is to see, okay, and just think about what these numbers really are. It's the same thing as the chart, just in another form, okay? So, like if you're Windows Media Player or anything, or you guys, your old hi-fi systems, when you're listening to music, and then you see the little graphics go up and down, it's the same information, just visualized a different way. So that's how I perceive the charts are the same thing as the high-low board, just represented a different way. And so what Steve was taught, as he has explained it, is that the high is set. So here's the high, here's the low, 42.95, 40.54. At the beginning of the day, these numbers will be about 30 pips apart, right? That's the Asian channel, the Tokyo thing that I guess he's referencing for all the new guys. They set it, they push it up, they set the high. There's some volume committed at that number. Set the low that you're now watching this. So these 2 numbers are set. At some point, you're going to watch it do 1, 2, 3. This is the same thing that Steve has said the past 3 days. Now you can go over it, just watching it in real time play out as it is, right? So the charts are merely breadcrumbs of where these numbers come and go. They're blue and red whether it's hitting on the ask or the bid, and whether it's rising or falling. So you'll see it go blue, red, blue, red, blue, red all day long. Actually, on my other monitor, I changed the color to make them different so they're more aesthetically pleasing. But what you'll see is when they're testing the high, so let's say, all right, so pound finished off right off the high. So 1, 2, 3. So let's say these 2 numbers, they're about 40 pips apart. And then, bam, all of a sudden the high is 20 pips bigger than it was. And 15, 20 minutes later, 30 minutes later, bam, it's 20 more pips higher. And then 15 minutes later, it's 10 pips higher than it was. No, I just kind of watch it, Mandy. She's asking, do you continually write the numbers down on a separate piece of paper to keep track? I just watch it. Just watch it for a while, all right? I pop Ginkgo biloba so you can focus. So it's like, okay, yeah, 42.97 was hit. That was the high. And then, you can pop over to the chart and see, okay, well, that's what it hit, so you're not having to track it necessarily. It's the same information, it's just visualized. So if you just pop over the chart and you can see, okay, they came to the high and pulled off it, came to the high and pulled off it. If you were watching that in the numbers, you'd see the same thing, that it was right at 63.96, and then all of a sudden it's 63.82. 63.96 back to 63.82. 63.96 back to 63.82. You can see that in real time, that it's hitting the high but not taking it out, right? And so when you see it and then you see that it closes off the high and tests it but doesn't take it out, you're good to go. The 22.59, that just means our servers are an hour apart. So after 3 pushes, I'm looking at the chart. I have the 2 monitors right next to them, so I'm looking simultaneously kind of at the numbers and the chart. It's not either or, it's both and. Sean, you're not getting the benefit of the high-low chart.
If you're having trouble, Sean, you don't need it yet.
Yeah, if everything I'm saying right now is like, what the hell is this guy on? I don't know what the hell Steve's telling me this. This just confuses me. Then disregard what I'm saying and just look at the chart. If that works for you, fantastic. I'm saying that for some people, there's a way of, and this is just back to how Steve was taught, was watching the high-low boards, and this is what bankers watch, is where price is and how they're working the bid and the ask, right? Their tool is the spread, right? So if you get a true ECN platform, and if you see all of a sudden that the bid is holding steady and the ask is fluttering like crazy, think about what's happening, right? They're letting people buy in, but they're not letting anyone sell. So when one side of the spread is holding and the other one's increasing and rising and getting erratic, then think about what's happening. Understand that for what it is. There's orders flooding in on the buy side, right? But anyone who wants to sell, market makers are ensuring that the bid will not go any higher so that no one, absolutely no one, can book a profit, because the bid needs to rise above the ask for the person who bought in at that ask to book any profit. They ensure that that does not happen. That's where the screw you point comes at the high of the day and the low of the day, inversed. Does that make sense? Let's see, more questions. Tony, yeah, that's what tells you the new high and low of the day. Twice TDI, less and less. Crawling the herd, exactly, yeah. Seeing where the volume is, hitting the high, people do breakout trades. Breakout trading is one of the most popular asinine, guaranteed to fail 50-50 proposition trading system. You just put your penny above the high to see if it breaks out without any understanding about what's really happening. And so the human psychology works in and they see 1, 2 hits. Oh, well, all right, I saw 2 increases. I'm going to wait for that third confirmation to see if it's a true trend start. And so they hit that third time, and then people put their breakouts right there above the thing, right? So that's when you'll see that. Why does price drive anywhere? That's where the volume is. Price went there because there was some volume of idiots that came in and put their orders right there. So that's exactly where they drive to. And that's why you'll see that last tap. Bam, grab them, and then it pulls away. Before they even know what's going on, they're down and we're up. And so when you start to be able to recognize that, that's when the fun becomes, as Steve did with that Aussie trade, watching, okay, the high's set. Let's say the high on Aussie got set in at 105.26. He could have been watching this at 2 a.m. and it's 26.4. And then price is trading 20 pips lower than that. And then like maybe 30, 45 an hour later, it comes right back up to it, but does not take it out. It'll scream up to it, right, to induce people to think, oh my God, it's getting, I got to get in, click long, and it styles. It's like it hits an invisible wall naturally, right? And so, Steve, as you're saying, so it came back, it trades lower, maybe 105.20 or 105.10, 105 flat, and then 30 minutes later, there was more volume that people were saying, okay, I'm going to take a breakout on that. So it screamed right back up to it. Steve recognized that, took it short right where every other retail idiot went long, and you see the trade. Yeah, I have a little spread indicator, and it's in the forum. How do you figure volume? All right, let me answer one question at a time. Nick, yeah, look for the spread to widen at the high and the low of the day. And not so much widen, like just watch it start getting more volatile. It's a behavior, right? So you're looking for a signal within noise. Within the middle of the chart, it's almost like driftwood, kind of up and down, just seeing where the volume is, hedging it, slowly grinding it against the positions. They could take as long as they want if there's people trapped at the low. But right at the high and the low, there's a certain behavior that happens, and the price moves differently. It's like a different pacing. It's like all it's walking, 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 and then all of a sudden it's running, and it stops. Gloria, watch it when the market's open, and then as it's testing, and as any chart is testing new highs, you'll see that the high is increasing. Make sense? Is there a PowerPoint? People are asking for a bunch of PowerPoints. So I guess someone in the forum may have come up with some part of this.
Yeah, Scott. I don't know if everyone can hear me or not, but Elvin spent hours and hours, like you. I was worried about his ears. He did some PowerPoints. They're in the forum. They're sticky to the top. Guys, download that. Take a look at it. It's good information. Okay, a few more questions, and then I'm going to let Scott get off the hook. He did a fantastic job. A couple more questions, and we'll take a break, and we'll move on.
Yeah, Steve, I mean, you can chime in here just as much as well if you want, if you're reading these. Open, high, low, close. Eric? Can you see the same thing on a tick chart? Yes, you can, Reese. But it's you're too zoned in. Just pull yourself back and look at the 15-minute chart. Oh, yeah, the other thing I do is you can, on your platform, show the ask line as well. Now, on some of these, the crosshairs, when it's far enough apart, so you'll see two lines. You'll see the bid and the ask. It's you just right-click Properties, and then click on Show Ask Line, and then you'll see the difference between the bid and the ask. David, about 10. Here, I'll show you exactly which ones I watch. Not all of these. So Euro Pound Oz, and it's set up. It's grouped logically, so you know, like, all right, here's the majors, here's the yens, here's the crosses, here's the Swiss, here's the CADs. So you can be watching. All right, the CADs are getting worked on the bottom of this. The majors are getting worked on the top. The yens are getting worked in the middle. You know, lay things out, organize them. I'm not a incredibly organized person, but Steve's, I don't know if he showed that line, but uniformity does in fact matter quite a bit. It'll help. It just, if you just got every pair random, you're like, okay, what's going on? But it's easier for your eyes to track. How do you change the odor? I don't know. Put some deodorant on. Order.
That was pretty good. All right, guys. Good stuff. All right, we'll do a 7-minute. Scott, anything else to add, or you're good? I really appreciate it. It was fantastic work.
No, I think that's the crux of it. I think I've just taken what you taught and regurgitated it with through my lens.
Much better than the way I could ever explain it. All right, let's do a 7-minute. It's a little after 7. Come back. We'll get rolling on some stuff, and I'll talk about a little bit more about this, and then we'll move on. Okay. All right. Do I have the screen back? Yeah. Okay. All right.
Yep,
see it. All right.
Yep.
You guys want to start break now? I'm going to pull up the 7-minute and go. So see you in 7. Thanks, Scott. All right. Can everybody see my break screen and hear me?
Yes.
All right. Okay. Can you? A lot of people probably initially thought they didn't need to come to the Sunday webinar because they didn't want to see platform stuff. Can you just go over what we're going to cover and how they need to get a link to make sure that everyone is enrolled for the Sunday breakout session to cover platform? Go ahead.
Yes, I can do it now. I intended to do it later on tonight. Looks like everybody's here. Hey guys, this is Zen, just covering the scheduled events for Sunday. Each and every one of you should have received an invitation, whether you be new or existing students, that said that's an invitation to attend our Counting with Car sessions on Sunday night. If you did not get that invite, with either your welcome letter or you're an existing student and don't have it, please send me an email, because that's the same session that we're going to go in. We're just going to change the format for Sunday night, and we're going to cover a list of things that Steve has asked us to do. It'll be very beneficial to you. A lot of you people have work time ribbon issues and offsets, things like that. We will cover all that. So if you did not get that invitation, which you should have with your welcome, but if you lost it or it didn't come attached, shoot me an email. Zen, Z-E-N, at marketmakersforex.com, and we will be certain to get you invited. The invite will go out tomorrow. You'll have it for Sunday. The session starts Sunday evening at 6:30 Eastern Standard Time. And again, I'll cover this a little bit later on tonight, towards the end of our session tonight.
Okay, is it going to be recorded?
Yes, we will record that session, and we will post it in the forum.
Okay, cool. Good. All right, so listen, if you thought maybe you weren't worried about the time before, now you see how important the timing element is of the method. If you were going to blow that off, it'll be recorded, hung in there for you to view, or if you want to attend live, you should have an invitation. All right, man, sorry to put you on the spot, buddy. Thank you. All right, good. All right. Let's do this. Let me cover a little more about fractional disparity just to show you what's really going on. I'm going to talk a little bit about the levels and how they play into all this, and I'm going to talk briefly about how I was taught how to trade. I went over it a little bit. Now that you've heard this, had some time for it to soak in, we'll spend a few minutes on that, and then we'll get through the rest of the slides. I hope everybody's hanging in there and having a good time. I'm enjoying myself immensely. Okay, let's see. Let me open up a piece of white paper. Okay, good. You should be seeing just a white screen. All right, grab my little pen over here. Okay, here's the deal. Let's just talk about pound dollar. All right. Euro dollar. Again, thank you, Scott, by the way. Okay, euro dollar, and then euro GBP. Okay, euro pound. All right, here's the deal. Understand that these guys are slick, man. It's about the money. So here's what goes on. There's 3 levels of rise or fall. There could be more, could be less. Market maker has the will to change the trend anytime he feels like it because where the money's straddled, right? It's about the money. There's no, like Scott said, there's no risk aversion. There's no other reason than the money, man. All right, so here's what happens. Let's just say on this example, GBP hits level 3 and goes into consolidation and holds. Okay? 1, 2, 3. At the same time, yellow's hard to see. Man, you guys are unbelievable. All right. How about red? Let's try that for your birthday. Erase all drawings. Change to... All right. Before I go through the whole thing, can you see that okay? Sorry, Alan. You guys are all right. Yes? Is red better? Is that kind of like a brick red? Okay. All right, cool. All right. So let me start over now. Sorry. Okay, here we go. Pound dollar, euro dollar, euro GBP. All right? So here's what happens. GBP breaks, hits the high, 3 levels, goes sideways. 1, 2, 3. GBP's at level 3. Euro breaks and is at level 2. Now, the cross still has to be worked because there's money in there. So here's what they do. Since GBP is already at level 3 and they want the charts to catch up to each other, right? Because when you look at them, people say, oh, they're correlated, they're really close. When you look at them in history or in hindsight, when it's over, they are lined up. But did you ever notice that GU and EU trade opposite each other during the London session? The reason for that is because they need to work euro pound. Right? That's a very heavily traded pair during that time of the day. People love that pair. It pays double pips. People get excited, that kind of stuff, right? So here's what happens. Euro dollar is at level 2. The pound is at level 3. So they'll hold the pound at level 3. And in the process of rising euro one more level to level 3, the base, which the pair happens to track by, will create the rise in euro pound. Okay? The advantage to us as a group is that to identify pound dollars at level 3, identify that euro dollar is only at level 2, the rise is expected, so then euro pound will rise. That's the edge. That's all the edge you need to be ahead of these guys on what they're doing. Okay, you know euro pound dollar has had 3 days of rise. It's flat now. Why is that flat? Why is that pair not moving? What's wrong with that pair? Euro's rising. pounds holding. That creates the fractional, remember, cross out the dollars, that creates the fractional disparity here and here. Why? If they hold the level in the quote, the base will create the rise. Okay? So euro pound might be at level 2 when this goes on. It'll come to level 3. Now all pairs are at level 3. Now here's what they do. They might correct pound first and hold euro, which then creates another disparity in euro pound. Okay? The base is the first pair on the quote. That's basic stuff, right? Base is the first pair. The quote or notional is the other side. See? Yes, people are seeing it now. Okay? That's what's going on in the background. You don't realize this, but you're looking at one pair in a little 5-minute chart, staring at it, and you're going, I don't understand. I took CHF short. It doesn't move. The majors are used to work the entire board, as I stated earlier. How do they do that? They hold CHF, move the other majors. That creates the disparity in euro CHF, pound CHF. Understand? They move yen, or yen goes flat for a day or two. Why? They want to move EJ and GJ aggressively. The move comes to them at a discount. It's cheaper to flash the major and move it, and it spills over into the cross. It's cheaper for them to get it done. You didn't know this whole thing was going on behind your back, right? All this is going on every single day. There's a big dance. And it, like Scott said, it's when you understand it and know it, it gives you like a calmness comes over you, and it's quite beautiful to watch when you know what these jerks are up to. So if you notice, man, GBP took off. It really extended far. Euro's not moving. Or GBP's at level 3 and Euro's starting to rise. Why are they doing that? They're holding the level of GBP at level 3 before another move is made to get Euro Pound to catch up, to get it to the level it needs to be. Then when they get GBP and Euro to the level and hold level 3 going into news or whatever reason, then the next move will start. You'll get a trend reset or the reversal. Okay? Thanks, Jeff. Jerry. Scott does have a lot of insight. Listen, him and Elvin, they've done the most work on fractional disparity, and I joke around that if you know the story about Van Gogh, he cut his ear off for his art, he went crazy. It is an art to understand this. It's crazy when you realize, man, there's so much going on. It's not just my little 15-minute chart of euro. There is just a monster mass of money flowing in and out in different orders and opening the bid and the ask and all this crazy stuff. There's a lot of stuff going on. You could really immerse yourself in this and drive yourself crazy. And I saw Scott like last time, and he had like a full beard, and his ear was like starting to bleed a little bit, and he was living there staring at the charts and the high-low board, and I was like, man, you got to get out of this high-low stuff and just get back to refocused on your trading. And I'm joking. That's not true, but he has really delved into it, and so has Elvin. Elvin has written up all the pairs and the crosses. Read that document. Okay, that's a good one. What I mean, the word fractional disparity. Well, if you follow the pairs, here, let me clean the sheet off. I think I just got to open a new one. Let me see if this does it. Erase all drawings. Cool. All right, look. If you follow the fractional pairs in the business, okay, I'll give you a quick, some people asked about this. This is called the base. I've heard this called everything from the notional to the quote, whatever you want to call the second one in the fraction, right? We know that if you flip this fraction this way, this is the numerator, this is the denominator, right? 5th grade math. If you don't know this, you're out of luck. I can't help you, all right? So now, the document in the forum is on sticky to the top. Go in there and look. It's right there when you go into general chat. It's right there. It has sticky to the top. Right, so here's what happens. One should rise and one should fall. So if the market makers create a difference, a disparity between the two, it creates the movement. So let's say they're holding U and moving E. If U is sideways, dollar, right, and E is rising, then this will track via the base. It will rise. Okay? That's what I mean. So now the disparity comes when U is rising and E is rising, and it doesn't make any sense. Or UJ, this is what I meant to say, UJ is rising and EU is rising, right? How could you have dollar strength at the same time? Risk averse, bank intervention. These are the things that are said. I'm not saying the bank doesn't intervene, but I'm telling you that these excuses you hear on the news are crap of why the pairs are moving a certain way. It's just a lot of crap, and it's all about the money. When you understand this stuff now, you understand not to look at the news, not to look at the data releases, the numbers. It's all crap. Non-farm came out today. I don't even know what the numbers were, but I could tell you that they made second leg of W and second leg of M in all the majors. Think about that. How in the world could I possibly know that unless there was truth in what I'm telling you? How did I know they were going to do it after the session changeover, the second pass at the low or the high? How could I possibly know that? How could you possibly know that? Some of you sent me projections. It was beautiful. Think. The news is shit. Yep, crystal ball. All right? How can market makers hold a pair? I don't know, Deb. It's crazy. They'll hold all the orders on one side or not absorb the orders, or absorb the orders on one side and then hold the other. It's crazy. But you see it in the chart. It's sideways. It doesn't move. That pair doesn't go anywhere. Yeah, some people ask me, do I think my life's in danger? Are they going to come after me? I don't know. If I fall off the face of the earth, you know what happened. Okay? Anyway, I hope you guys are enjoying this stuff. It's crazy. I'm going to spend a few more minutes going over how I learned how to trade and why you guys have it easier. All right? But what happens is I always explain this, and then somebody like Scott or Elvin goes berserk and takes it and goes, that works better for me mentally, and it turns the corner for them. That's why I take a few minutes to show it. Okay? So we'll do that. All right, let me clean the sheet off. Okay, look. If you're going to trade this way, you need a good notebook and a lot of ink. Here's what you do. Okay, I like to put up a chart next to it at the same time, a picture, so maybe that'll help a little bit. Let's see. Let me get out of this drawing mode. I'm not going to spend a lot of time on it because I don't want you to go crazy trying to figure it out. It's not necessary. Okay, let's see. All right, can you see that? I have a chart next to the white screen, okay? And I want to isolate one segment of the chart. Let's see. Let's isolate this segment of the chart right here, which is the typical setup stuff, all right? Okay, cool. All right, here's the deal. Grab a pen. Okay. The initial high and the initial low, right, like we talked about, the ILOD, initial HOD, sorry, and the initial low of the day. Here's what happens. Initial low. Okay? There's some number. Let's just put arbitrary numbers. 129.20. And because I'm half retarded, I'll make it like 12900, so it's 20 pips, right? It's easier to do the math. Okay, when you look at the high-low board, 129.20 is going to be the high, 2900 is going to be the low. That is simply subtracting the initial high and the initial low. You got a 20-pip market maker spread. That's the little number, not on this template, that comes in right here. It tells you the range. That's the Tokyo channel. That's how that number's derived. That is really called, behind our back and by banks, the market maker spread. Okay, we've named it different things. Craig coined the phrase Tokyo channel, which I kind of like. It's the Asian range, Asian session, whatever you want to call it. But what it amounts to, it's the market maker spread. The difference between the high and low coming into the London session. So what I used to have to do is I used to go through all the pairs and subtract the high and low at 1 a.m. New York in the winter, 2 a.m. in the summer. I would subtract the difference between the high and low, and I would fish out the pairs. This is before charts, right? It shows you how old I am. We had charts, but we didn't have the kind of indicators we have now and the freedom to use them like this. Okay, so I would take the difference between the high and low at 1 a.m. in the wintertime, and I would say, okay, minus 20. This one's The difference is 20 pips. This one's 75 pips. That's not ideal to see it. Let's get it out of there. Okay? And I would look for tight, wound-up Tokyo channels. 20 pips, 30 pips, to a maximum of about 50 pips. 50 pips is the ideal way to see the move. Then the 3 bursts are hidden in the board. This is the whole time doing this off the high-low board, okay? So now, when I see them cut it, let's say they cut the high, and it's going to be a 50-pip stop hunt. 24.20 immediately changes to 24, let's say 25 pips. Let's say 45 or 47, some odd arbitrary number, okay? Then the board will pulsate. This is, it should have went down. Let me say they cut the low. Hold on. Let's back up. It's easier because I'm showing the example on the chart. Sorry. Okay, so we're at 12900, right, is the low. I see it on the board. They extend the low, spiky, right here in 3 moves. 1, 2, 3. That's the low of the day, right? But when you're looking at the board, here's what you see. 2900, a quick hit of 25 pips. It goes down to 2875. That's the board now. Now it pulsates. It sits there. And then they hit it again, and it goes 2862. Arbitrary numbers, all right? Then they come back for the last tap, and they open the spread at the very low of the day, and they go 2858, okay? And they hold 58. That's what happened in these 3 candles. When you see those candles close, the damage is done. When they quickly pull off and you get the close of the candle right here, 28.58 immediately shifts right back up to 28.68. They're off of the low now. 28.68, all right? I know I'm a terrible artist, man. I'm sorry. So now when you see the candle close, they've spiked the low, extended it in 3 pulses or 3 moves. That's where the vector comes from. A lot of the times during the week, he takes about 45 minutes to do that behavior. That's where vector 3 comes. You see 3 candles right out of the box, straight down. That's a work of art. He did it in exactly 45 minutes. He worked the low. He broke it in 3 pushes, a 25 to 30 pip hit, a 10 to 15 pip hit, and then I always do this. I have to do it. He does like a little bing at the bottom. There's my little sound effects for you. The little tiny tap is he'll go right to the low, open the spread, and just hit it one more time. That little tap takes out anybody that got it right, that got the right direction long. They open the spread and grab those stops. It also gets anybody that was trying to break below that number, picks up their orders, turns them hot. It validates anybody that was working on any kind of fib extensions or anything like that. It validates and turns those orders hot. The fact that he closed so aggressively off the low, if you could break this big candle down into 1-minute candles, you'll see this. You'll see a W in there. You can turn it to a line chart. I know Dick does that, and he loves it. Okay? So when you see one candle spike to the low, we call it a V bottom. But technically, if you go down to a smaller time frame, you'll see a W or a nice V pattern where they hit the low and work it. But what happens is when they get to the 28.58 low, they just stay there for a while. In this example, they did not stay down there very long. But they might hang out there for 10 or 15 minutes, just hang around there. And then in the last minute of the candle, they'll whip it all the way up and close. And you'll notice that when you start to watch these things. It's amazing what they do. When you start to watch them work, that's where I think Scott got so carried away. Just watching them work really is fascinating. And then when they shift the zone away, they get away from the number. The candle represents the pain they've inflicted on the lower level short holders. When that candle issues that big wick right there, right? When they issue that big wick, the damage is done. They've come off 28.58 and immediately moved to 28.78. Add the spread, people are down 25, 30 pips depending on your pull and your fill. If you filled at the worst possible spot when that candle was solid red down and you open because you want to get a good entry and they whip it away from you, man, you're down 20, 25 pips plus 2 to 3 on the spread. You're down 28 to 29, 30 pips. That sucks. That's what they do. So now that's how I used to learn how to trade. I would look at push 1, push 2, push 3. That's your vector. You see it easier on the chart. They extended the low in 3 moves or 3 swipes. That's where that comes from. Okay? Then they'll consolidate off of the low, right? Right in here. And hold it. And people think, oh, it's an opportunity to re-short myself. No, you know what they're doing. The market maker trend is up against the retailers. The spikes to the top side induce people. They show them the things they need to see to induce them to go the wrong way. And then after they do that, they hit them again and stop all those guys out. And if you lifted your stop and were crazy enough to fall for that, you are now stuck on a bad projection this way, and you're dragged the wrong way for the entire cycle. And if you are at day 1 of the market maker cycle, you will be a unidirectional swing for 2.5 days against your position. You cannot book a profit until week end on the retracement, or you will not book a profit at all. They will not come back. If you happen to catch quarterly low, seasonal low, you're screwed. If it's the weekly low, all you can hope for is that you get a retracement on Friday, but really you should just be stopped out. But I'm telling you, that's the stuff. Ever sat there for 2.5, 3 days and don't see any relief and don't understand why? You throw the stop on, you go, oh, it's coming back a little bit. Then it turns around again. You were going the wrong way on the cycle. This stuff got you. Up, consolidate, this retracement, you think, oh my God, it's coming back. Thank you, I'm getting out. Sorry, stop hunt, just kidding. They go into consolidation the next night, comes back a little bit. Oh, if it just falls, I'm out. One more day of rise. Now, the only shot you got is they take the net change back for the week and end back by your position. Okay? The information above could be mistaken for an M, Sammy, in the level 1 consolidation. But this is level 1 consolidation coming out of the intraday move, right? You know, let me clean this off. You know better. You know what's going on here. There's your consolidation. The first move is false. Level 1, level 2, level 3, right? 1, 2, 3. You don't take short positions until level 3 is seen, and they throw you a signal. Okay? Remember, you don't counter at a level 1 consolidation back towards the peak. You know that. That's a no counter day, right? DNC, do not counter. DNCT, do not counter trade. This, do not go against the peak formation low coming out of level 1 consolidation, intraday or intra-week. It's a sucker's play. That's why it's a sucker's play. Because they don't come back. They show you something to make you think it's going to come back. Retail traders trap. The business is about trap and move, right? Stick and move, stick and move. That's what they do to people. They show this. That looks like a reversal, right? It's pretty. But we know the cycle, the anchor point formed this day before. We know WVVM. 3 days of rise, 2.5 days. You don't take a counter coming out of level 1 consolidation intraday or intra-week ever. All right? So anyway, seeing this on the chart is simply the numbers. That's how I learned. And I used to have to track all the majors. I had notebooks. I used to write it down. They cut it, write it down again. It was very difficult. I don't even know how anybody could have learned. That's why it took me six months. I thought I was half retarded. And the guy would tell me the same shit. It's simple. What's the matter with you? Come on, it's easy. Don't you see that? What's wrong with you? See, they hit it again. It's pulsing. They hit it again. I'm like, oh my God, I want to kill this guy. Just like you probably feel about me right now. I understand. You got to change your mentality to his side of the screen, and it's hard to do. If you've been in the business a long time, it's stressful, man, because you can't let go of the, oh, rally base drop, the average crossovers, I take this, blah, 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 right? You can't help it. It's crazy. But I'm telling you, I have too many successful students that you guys can't get it to. Okay? All right, man. I don't want to spend too much more time on that. That's a close. I hope that helped clear it up a little bit. Good enough explanation. But that all ties together. There's a big dance going on. It's all right, man. Some people say they still don't get it. It's okay, man. It's not important to be successful. Just look for the patterns. You're not an idiot, man. It's just confusing. It is confusing stuff. All right. No break for you guys. That's enough already. Okay. Let's get back to the slides. Some people saying clearer, some not. It's okay. All right. Any other questions about disparity or anything else before we move on to the rest of the stuff? All right, cool. I just want you to understand that there's something grand going on with these guys. It's a huge thing. It's not like, oh, I look at my little 5-minute segment of the chart and I'm like, there's so much going on behind our backs and so much money in play that it's just crazy. So what you have to understand is that don't get caught up. Like Scott said, he took the bigger picture in. That's what a lot of you do. They teach you that in regular classes. You're like, oh, you look at the chart right here, you focus on the 5-minute chart and you look. That's bullshit. There's so much going on. They're working the cross, holding the major, messing up the fractions. This goes on in all markets. Yes, all markets. This stuff happens in all markets, man. Why? Because the same things that drive Forex, fear, greed, fear of loss, fear of missing the trade, missing the opportunity, holding it thinking because you took it it's going to turn into a 1,000,000 pip run. Okay, that's the kind of things that are human nature, and they're in every market, so that's why this stuff is universal, all right? And it translates in every market. Okay. I understand there's no disparity in stocks, but the behavior's there. All right, get out a piece of paper. I got a couple questions for you. Number 1 to 3. There are 3 market conditions that you should be able to identify, and you should know what they are. What are they? Write them down. I'll give you 30 seconds. Go. All right, time. Okay, what are they? Anybody? Okay, here's the answers. Consolidation accumulation, stop hunt, trend. That's it. Too simple, right? Let's think about the conditions for a second, though. Consolidation, accumulation, they trade between a range and collect contracts. The stop hunt used to be perceived as market momentum, but you know better now. That's an aggressive move out of the Tokyo channel, up or down. It's fast. The stop hunt is fast. The trend is slow. And then the trend move for the day, the market maker trend move. Slow and steady, 6 to 8 hours in duration for the session, can carry into the next session. Right? Think for a minute. False move session ending, false move session beginning. So the London guy can push it down some more. The U.S. guy takes it at 9, pushes it down a little bit more, and then at 9:30 makes the reversal. That's his session beginning. He draws out the second leg of the M or W. Then he will rise slow and steady because he's heavy. Okay? He becomes net long, puts on the brakes, and turns. All right, why? When price is dropping, he's buying from the traders to create the positions. So as he drops the price, he becomes net long. He has to rise price to get out of his positions and book a profit before he goes into consolidation to end the day. Right? Think. Consolidation, choppy market. We call this also level 3 behavior. You'll see this at the top of the runs. Level 3 behavior, right? Consolidation, accumulation. Simply a matter of collecting the contracts, perhaps holding the level to bring the other cross up or to bring the other major in line with it to get everything at level 3. Think of all the things going on now that you know. Why is GBP at level 3 for a week? They had to work all the other pound crosses to get everything else caught up to level 3 too. They had to get them up there. They had to work euro pound to get it there. Okay? Stop hunt. A fast, aggressive move, vector, against his real move. A false move against the market maker's move. A fake out. A head fake, whatever you want to call it. I love that term. It kills me. There is no head fake in Forex. Okay, and then the trend. A slow and steady, relentless rise of 3 levels, 6 to 8 hours in duration. Can continue through both sessions. Okay? A sneak attack, if you will. Yeah, stop hunt, sneak attack. Cool. The stop hunt looks like a race. It's fast. Like it gets all the guys that are emotional going the wrong way. Think about how many times you've seen it, got excited, like, oh man, I'm missing Euro today, damn it, and you chase it. Breakout traders absorb the orders on either side, widen the swing. That's what it looks like. That's what it sounds like. Those are the conditions. And as a trader, it's simple. You apply the appropriate reaction to his actions. He consolidates, accumulates, and builds contracts during the Asian. All right. Somebody's taking a shower or something, or I'm echoing. I don't know what the hell that was. All right. We're still good, right? All right. I'm pegging. Okay. Consolidation, accumulation. You anticipate the stop hunt. You're waiting for the vector to show. You're waiting for a repeat of the second leg. You're waiting for him to repeat a level. You're waiting for him to come back to yesterday's low, or maybe London's low, in 3 swipes, 3 pushes at that. Now you understand more clearly where the 3 swipes have come from. It's 3 pushes or bursts. Could be in 1 candle, could be in 5 candles. I don't know. But when he lays it out for you in 3 candles, one on top of the other, lights out, man. You own this guy. And if he makes a third pass, at that high or low, you're going to be able to grab really close to the high or low, and your stop's going to be like 3. Okay? When the stop hunt appears, you wait for the signal or the setup. That's the next thing. Wait for him to calm down, stop cutting the low, and go into consolidation. 30 to 90 minutes. If he makes a spike to the low and goes into half a Batman mode, you can calmly deal in the consolidation zone. If he makes the second leg and comes back, you need to grab when the second leg shows the color of your direction back. One more time, then I'll draw it. You need to deal when the second leg comes back and shows the color of your direction. What do I mean? Okay. Here's my little pen. W. Spike to the low, consolidation. Okay, market maker throws a railroad track. He goes down 1 candle, 15 minutes. He does not take out the low, or he pins it and comes right back the other way. When this candle closes, you need to open your trade right there. Period. Why? Because he got the last batch of suckers on short and hit the stops of the people that were correct. He is going to shift the zone. I want you in before he shifts the zone away from you. He takes the trade out of your hands. So your stop loss goes right outside his grasp. How do you know that's safe right there, Steve? Because he ain't coming back for your 1 contract or 10 contracts. He's got too much money in play for him to come back for 1 dealer, 1 trader rather. Okay? So now, you know the shift candle comes in right here. We'll call it SC, shift candle. You know that comes in, right? So what you want is, you want to open your order immediately at market and be in. And then guess what? It's going to be a painless trade. Yes, Craig? Hey, I'd like you to call me when you have some time. Maybe next week. Okay? You know the shift is coming. You're going to get a painless trade. Painless. It's going to go straight up in 2 or 3 bars. Why? He's got to get the hell out of there to get everybody into a panic. So when he gets out of there, you're going to be in profit already, man. You might even be out. If you're going for 30 or 40 pips, you might even be out in 2 or 3 bars, 2 bars, 1 bar. If it's like GBP CHF, the shift bar was like 75 pips. It was over. And then you're going to do something I don't want you to do. You're going to go, damn, that was too easy. Let me hang around, see if I can give it all back. All right? Don't do that. If you make your money in the day, and this is the hardest thing, man, it's going to come easy for you. You're going to start to see it, and you're going to think like, man, that was too freaking easy. I need to hang around. So you're going to start chasing stuff. That comes later, man. We'll talk about where you get in on the pullbacks and the levels and all that stuff. Right now, I just want you to understand. You deal right off the low and right off the high. This is going to happen. So what I meant about the color is this candle is red. I got off track, sorry. This candle's red. This one turns green. What you're going to see sometimes also is he'll do this, consolidate, come in, make some baby candles, and go like this, right? He'll issue you a green hammer closed in your direction towards the top. You deal right here, and you're going to get your shift. Yes, this happens right after the stop hunt. When the stop hunt calms down before he starts his trend, he's got to shift the zone and create the panic. and then he'll get away, he'll get out of there, you'll be up, he'll go into level 1 consolidation. The level 1 consolidation is to validate the retail traders back in, rally-based drop, drop-based rally, that stuff that's in textbooks. When he goes into, he might even throw pins to the top side to trick you. But I promise you, there's enough pips in here from the end of the stop hunt, when he shifts the zone into level 1 consolidation, you'll limit up almost always. Okay? Good stuff. Stop loss is below the low. Okay? If you deal second leg and get in here, you can use 7 to 10 pips below the low. Why do we do that? In case he comes back for a third pass. I have no way to know what's down there. I don't know if he's coming back for a third pass. Right? Sometimes he does it. You've seen this week, he did it twice in a couple of pairs. That was cool. He gives you an extra opportunity. That Australian trade I showed you was about 2-3 weeks ago. He did it in that pair, came back for a third pass. I want you guys to be of the mindset of that. If that jerkwad gives you a third pass, you take them. And you get in with a 5-pip stop loss. All right? You'll see. You'll start to see when you start looking at it with a different eye set or a different mindset. All right? You're going to see it. I know. Granny does it all the time. I love it. That's the granny trade. We should name it the granny trade. Okay? You're going to freak out when you can get within. Look, I was like 0.3 pipettes of the high of the day, man. It's amazing. Okay, good stuff. All right, so we're going to talk about moving averages. I don't want to talk down to you, but I want you to understand what you're looking at, how to get all the charts off your screen and get down to one chart. Okay, Fred nailed Euro CHF, third pass for 50 pips. Beautiful, Fred. All right, we'll talk a little bit about the averages, how we draw the averages into the 15-minute chart and understand what we're looking at. A lot of you know this stuff already, and I'm not trying to talk down. I just want you all to understand. I don't want you to look at a million charts. You have enough to worry about disparity. How are you going to look at 1 hour, 4 hour, daily, 15-minute on 10 pairs? You're not. It's impossible. You look at the 15-minute, 1 hour, you draw your biases in like Carr, Kim, and Granny to get an idea of the directional move, and then you close that shit and you look at the 15-minute because you know where you are in the cycle. Okay? You can't possibly look at all those charts. No, the zigzag indicator will not help you because it zigzags all the moves in the pair. You have to draw the market maker trend. Okay, M&W formations we talk about, they're important. Pivot points. Some people like pivot points, some people don't. If you don't like them, throw them out. But I'm going to show you how we use them as part of the system to help us understand where the low might come in. And that's important. The whole business is about the low and the high. Spend a few minutes on TDI. I wanted to mention that Dean from Compass has offered to do a separate breakout session on TDI. If you guys feel like it, he'll do it, and we'll hang the videos in the forum. Kim will come in with an announcement on that when they work out the details. That's up to Kim and Dean to work out the time and date when his schedule allows. And sometime between now and the Dallas class, we'll do that to give you some insights on the TDI. TDI is helpful when you understand the context of it in our method, and it will help you. We have shark fin, hold a mayo, that kind of stuff. We'll talk about, okay? All right, I'm going to go through this stuff a little fast because I know a lot of you know this, been trading for a long time, and I don't mean any disrespect or I'm not talking down to you, so don't take it like that. But I want you to understand how we use it, okay? So they can give you a true reading of the market direction when in the proper context. If you understand that to read the averages after the stop hunt occurs, then they're going to give you touches to the mayonnaise, touches to the mustard or the ketchup, and help you understand where you are in the cycle and what level you're at and so forth. Okay, they do offer a true reading of market momentum when understood that if price is rising and none of the closes breach the mustard, they stay above that. That gives you an idea that there's still energy left in the trade. If you want to hold for longer than 50 pips, that's okay. They do offer reliable entry and exit signals when in the proper cycle. If you're at level 3 and the candles are away from the mustard or the moving average and they collapse back below and close inside and go into consolidation, that collapse back inside gives you the signal that the move is probably over. And because you've reached level 3 rise or level 3 drop, the price has been trading off of the average all night, then it pulls back to the average. The average is exactly that. The average of the price closes is losing steam. So now you look for your higher day has formed and price collapses back inside the average. That's how we can help us guide ourselves through the market maker method, okay? they are moving support and resistance points because they lag. The 200 usually comes in right around mid-range. That's why we use it as a target. The 50, Jim, if you're listening, it's about like a, what is it, a 0.23287654321 retracement. When you get a retracement in the watermark, it's about, I'm busting chops, it's about a 23% retracement off of the high, and the water's an easy target. Okay, if you want to grab a counter to the market maker trend trade, which Zen and Diane will talk about, you have to adjust your take profit. Okay, because you're not going to get the full move like you might have had overnight. If you get an overextended move during London, you can get the retracement back to the water for 30 to 50 pips regularly, no problem. I know Deb does it. I know Zen and Diane do it. I know some people like Granny and Kim, they like to trade the U.S. session, that kind of stuff, all right? If I'm going too fast, let me know. I'm not going to read to you the definition of an exponential moving average. I just found that when I was trying to convert what I learned from the board over to a chart, that the exponentials lined up better. That's all. There's no particular reason why I'm using it. They're just weighted a little different. That's all. Okay, the settings for the class. Okay, you asked me this. I'm doing it again one more time. Okay, here's my pen. Ketchup. Mustard. No, I'm backwards. You guys confuse me. Mustard, ketchup, water, mayo, and I don't know, blueberry. Everyone calls it something different. Yeah, Dave. Dave wanted to make an acronym with my initials, and I felt like that was really full of myself and vain, right? To do like M for mustard, A for avocado, I don't know. It's kind of funny. Anyway, really, I was like, I think it's really cool, but I think I would really be full of myself if I did it, right? Okay. All right, the simple stuff. The 5 and 13 are the signal lines when they make the stop hunt back and they bounce off of one of the signal lines and they open back up, that kind of stuff. All right? The 50 EMA is your balance line. Once you get the crossover after the stop hunt, then you're looking for price to stay above the water. You're going to get a bounce back to the water. That's a 50-50 bounce. I'll cover that in a little while. 200 EMA is home base. That's the 1 hour trend. The 800 is the 4 hour trend. The blue line, okay? Your biggest concern needs to be water, mayonnaise, and blueberry pie. I don't know. If you guys come up with a good name, let me know. Nothing vulgar, though. I had some other comments before. Okay. Just want you to understand that it's important to note that the 200 EMA, the mayonnaise, represents the 50 EMA on the next higher time frame. Think about it. If you're looking at a 50, it's 4 times, right? A 15-minute is 4 times lower than a 1 hour, so it makes sense. The 200, we bring it in. If price is trading above the 200 or below the 200, that's where price is in relation to the 1 hour chart. So the mayonnaise represents the 1 hour chart. So you don't have to go back and look at it. You know you just had a 1 hour crossover. Okay? The same thing with the 4 hour. The blue line represents the 4 hour chart on a 15-minute entry window, trading window. So you realize, man, price is above the blueberry and it's above the mayonnaise. You realize that price is trading above the 1 hour and 4 hour. I'm probably in day 2 or day 3 of the cycle. That's how that fits. Understand? When you look at the chart and it's above certain points or averages, and the averages are starting to fan open, you can almost say, man, I'm in level 3. The averages get wide open, I'm in level 3. Price has been rising long enough to fan those averages open. That's what you have to understand. That's the relationship I want you to take away from this. Okay, so look, this is what I mean. Looking at the charts, okay? There's your mayonnaise. That's this line right here, drug over and plotting here. Why do you need to look at the 1 hour chart if you know where the mayonnaise is? Price is trading above the mayonnaise. Why do you got to look at the 1 hour chart anymore? Get rid of it. It's junk. I thought this was kind of interesting too. Look at the averages. Crazy, right? Okay, so that would be 2 pins to the mayonnaise, this trade right here. It's kind of cool. This would be 2 pins to the mayonnaise probably. The average went down there and hit it. Yes, the EMAs can help you understand and draw the levels. The more wide open and fanned out the averages are, right? What do they say in regular textbook? The trend's overextended, exhausted, whatever you want to say. Trust me, those guys ain't tired, man. Trend's not exhausted. It's where the money lies. Okay, so just understand. This is what you're looking at. The 50, the 1 hour 50. Okay, so the next thing to do logically is to bring in the 4 hour 50 and know where price is in relation to all those, because they fake you out at those numbers. I didn't invent that. That's what they do. They fake you out at the 50 because people trade 5,200 crossovers. People trade a break of the 50 EMA. They trade a break of the 1 hour 50 EMA. That's why you see them stutter at those points. Not because, they say the bull and bears are fighting over there. That's crap, man. They do that. They go into consolidation. A lot of times you'll have a push up and you'll get level 1 consolidation right at the mayonnaise. Okay, here's what I mean. Here's the 200. Price will do this. It'll go like that, right? Then it'll run up, and it'll come out, and it'll do level 1 consolidation right there. This move, people anticipate this because it stuttered at the 200. They go, it's going to hold. But you know, if you're in the cycle trumps everything. That's how you can anticipate the continuation. That was a good one, Dave. He said bullshit and bear shit. That's pretty good. All right. Look, the 50 and 200 are used by most institutions. They use them on the daily chart. They use SMAs. I even think that Barron's newspaper that comes out uses the 50 and 200 chart with a MACD or something. You guys read that stuff. They appear in every single trading textbook I've ever looked at. And the 513 just so happened to match up with the TDI and give pretty responsive signals for what we're looking at to help the touches and see where the stop punts come in. I didn't invent these moving averages. I'm not taking credit for them. But trying to figure out how an average could be used to help us in extrapolate, big word for me, extrapolate the market maker cycle over to a regular chart, this is what I came up with. I didn't invent it, and I'm not taking credit for it. But it just so happens that when I watch the charts, they come back and pin to 13 for a stop hunt, for continuation. It's just amazing how it matches up. So we went with it, okay? If you find something better, let me know. We'll try it. We'll test it. We'll take some live trades and see how it does. Okay? I know there's some pretty sharp guys in here. I know Mac invented a platform. That's amazing to me. So if you guys got some stuff that can help all of us, I'm all ears, man. I want you guys to get this. All right, so let's look at the averages, how they follow price. Look, it's kind of crazy. Is that when you look at how this follows price, you can see the things that I've discussed in here. Right? It's crazy. They're in here, in the averages. What some of the guys were doing in Dubai is they were taking this and they just started using a line chart. And they were trading off of line charts. If candles scare you, that's okay. The candles are designed to go up and go down and to look erratic and to mess with you. It works, man. How do I know it works? Because we wouldn't be holding this webinar right now if it didn't work. It fakes you out. It forces you to take +5 when they make the pullback because you don't understand the cycle. And it forces you to hold an open trade -30, -40 until it comes back or until you run out of margin. So that's what these guys do. You can use a 1-period EMA as a line chart to help you see the W's and the M's. That's okay. All right? I just marked that up for you with the ballpoint pen. Notice in here you'll get the stop hunts back to the catch-up. Stop hunts will come back to the catch-up. Price goes up, makes the pullback. Level 1 consolidation, perhaps. They pull back again. Okay? They come back, hit it again. Stop hunt, continue. Right? Remember I told you there's zones. The price will be 20 to 50 pip swings depending on ADR. Unidirectional swing after the stop hunt comes in. That's the stuff I want you to notice. After the stop hunt comes in, there'll be a unidirectional swing till the high in this example, and then they'll reverse. Or the next night, they'll end the day in consolidation off of the high of the day, trap the traders and leave them stuck to pay swap for tomorrow. Okay, see it? Hopefully you guys can see it. It's crystal clear. It's right there. All right? Here is another example of 2 pins to the mayonnaise. Look, they made a nice drop. 1, 2, 3. They came down, painted a big fat W. There's your entry. See, now, see the momentum and the separation? Okay, that gets worse as you get up here. You can project this. It'll get wider and wider because of the lag. Then you know that you're probably at level 3 up in here, and you expect to collapse back below the mustard. And when it hits the ketchup and locks, if it doesn't bounce, that's the end of the trade. All right, same stuff. I just want you to see how the averages play into it. Pins to the mayonnaise. 1, 2, 3 to the high. This is over a bigger time period. Works on the bigger time periods, man. Hit the high, second leg M, reversal, imminent. Okay? Good stuff. Okay, just understand the greater the angle and separation of the moving average, the more likely you're in level 3. That's what I want you to how to read them. I want you to read the averages like a regular guy because you'll get whipsawed, right? Funny. The averages are to be used after the stop hunt and the market maker trend is underway. You're looking for level 3, back touches to the ketchup. See where you are where the stop hunts come in. Okay, and like we just did, it's useful to look at averages devoid of price. Take price bars off. I guess I can add that to the list of something Zen can teach you how to do. Sorry, Zen, I'm piling it on, dude. I feel really bad. Show them how to take the candlesticks off of their chart on Sunday. For some, the pattern becomes more obvious. I know Dick loves this. I know a lot of other traders could just go to a line chart and use the averages and go, wow, I wasn't sure if that's a W, but I see it now. Easy trade. You could maybe make a small template, and when you're not sure, pop that template on your chart of just the line, and then you can look at it with a different perspective and see if that is, in fact, your setup. Okay? Now, when you put the averages in line with the timing, it's solid gold, right? They come out at the London Open. These are the higher time frames. We know the trend is down. We're probably at level 3. Market makers make the aggressive move towards the downside. They come back and give us the crossover and continue. Right? We know, look at the separation, the angle that's away. It went back into consolidation. The averages still didn't catch up. Okay? So now you know where you are. I'm at level 3. I've had a couple of days to drop. I'm at level 3. They went back into consolidation. Sorry, pulled my dashboard over. Back into consolidation. They're holding it. I expect stop, hunt, low, reverse. If you got stopped out here, they hit you again. Take it second time without fear. You know how to handle that. Okay? And that's where the trade ended up. Second leg, right through, right all the way to end the day, back to the 200 take profit, the 1 hour chart. And went right back to the 1 hour marker. Okay? All right, so since we look at the two higher time frames, the 1 hour, 4 hour, to get an idea, understand our entry window, understand when you drag the averages in, you're looking at the blue and the white. Once you understand the position of that, just close all that other garbage, man. Turn the TV off. Stop listening to Kramer. Whatever it is you guys listen to. Stop going to Forex Factory. Those people are lost, man. And by the way, they talk shit about me, so don't go. But seriously, those people are lost in the business, and they're just looking for some way to try to figure it out. It's a collective. I'm not trying to sound mean, but it's a collective crybaby session of everyone trying to figure out the markets together. What I want you to do is work in the group. Work with guys that are like-minded, understand what we're doing. Focus on what you're looking at. Look for the pattern. Get away from all the other rubbish that's out there that confuses you and gets you off the track of what's going on. I promise you that I am right in this business. Okay? And my students are my proof, I guess. Sounds like Congress. That's a pretty good one, man. Yeah, you know what? And that's a good point, Sammy. Thank you. You don't need to defend me out there, man. All right? I'm good. I promise you my life is great. You don't need to defend me. I know what I know. Don't get yourself all caught up in trying to defend me. I appreciate it. It's very nice. But I don't want you to exchange with these guys, because what happens is I have my KIA investigative unit, and if you guys are members and go in there and argue with them, when we ask to have the threads pulled down, they say, well, your own members are participating in the thread, and it makes it more difficult to get the thread pulled. That's why some threads are pulled and some are not, because our guys actually went in there defending me. Thank you. Very nice. Someone said I'm a life changer. Thank you. Okay. Thanks, Dale. Appreciate it. All right, man. Seriously. I don't want to get off subject. Okay, Ray. I think Ray has the indicator ready for testing or something. I got to look at it. All right. So what I want you to learn to do, like I said, is just look at the 15-minute chart, and you can tell where price is in relation to all the higher time frames. Once you do your initial check down and look for the levels in the 1 hour, draw your zigzags and have your bias, it's not necessary to look at all the charts anymore. Get rid of that crap. That's retail trader mentality. We're throwing that out. Keep your trading window open and your fractional disparity window open. And if you're like Scott, keep the high-low board up. If you like that, it's okay. That's cool. Okay? Scott actually made an indicator. He said it was in the forum, right? I don't want to put him on the spot. But I'm going to tell you how old I am. I grew up on a Jensen stereo or Kenwood in your car that used to have like the little equalizer box like right there, and it would show you like where all the levels were. You guys remember that? It's pretty bad, right? Like LED lights. Okay, yeah, I am. I know. So anyway, what happened is Scott took the pairs and he put like CHF and he put like USD, and then what happens is it's by the high or by the low or in the middle of the range. So this little LED light will tell you CHF's by the high, GBP CHF's by the low. Yeah, 7-band equalizer, man. I know. I'm embarrassed that I said that. Right? So you'll know which pairs are by which segment of the Asian channel or Tokyo channel, right? So now you know that if GBP's up by the high and Euro's down by the low, something's going on in Euro GBP perhaps. If yen is up, Euro's up, and GBP's up, something's going on in the yen crosses perhaps. Yes, Nick, it's on the forum. Scott, I don't put you on the spot, but can you text in there and let me know if it's still there? Scott wrote this indicator, and I'm pretty sure he hung it in the forum for everybody. I'll find out the details on it, and we'll get it to you guys who want it, or we'll start a thread and get it in there. But it's interesting because this is all part of I told you cut a zero. If the guy was writing code and figuring out ways to see which pairs are near the high and the low, and I don't want you to get too wrapped up in that, but I want you to understand there is something bigger in fact going on, but I don't want you to spend the rest of your life trying to figure out the disparity and like try to break into the dealing desk and hang out with these guys. You don't need to do all that. That's what he did. He went crazy. All right? And he does know the material very well and can pick the high and low of the day, but I assure you he was picking it before he went crazy. Okay? All right, I know I'm going over the dinner break. I think we got the M&Ws coming up. I think we'll break here. I don't know if you guys are hungry. I'm starving. I'll get Scott to email me when he has some time about that indicator. I think it's up there. You guys want to play with it, that's fine, but I don't want you to get off of the track of what we're doing here. But it is neat to see which pairs are near the high, which pairs are near the low, and that would give you a heads up to a fractional setup, okay? All right, I'm going to break here. All right, look, I was thinking about something earlier tonight when I first started teaching, when I asked about Dallas or bust, and an idea popped into my head, and I want to share it with you guys. But I wanted to speak to Compass first before I open my mouth, I guess. So after speaking with Kim on the break, Zen and I, Kim and Scott, and the people over at Compass are going to put our money where our mouth is. So what we're going to do is we're going to, underneath the Dallas or bust heading, we are going to pay for a block of rooms for any of my students that have ever taken my class. The only criteria is that you have to be willing to share a room with someone, roommate, and you have to have a need, man. I mean, if you're doing really well and don't need it, don't sign up. What we're going to do is we're going to do a raffle. We're going to see how much the room blocks come out to, what we're looking at, and maybe do 5 rooms. That'll be 10 traders, 2 per room. We'll try to keep the guys and the girls together, group by age. No serial killers, please. So we're going to do something along those lines, man. I want to do something to pay it forward, pay it back, whatever you want to say. So I want to sponsor some guys into the class. I've got a lot of letters from people saying they want to come, but they're just strapped for cash. So I think it's a good thing to do, man. So Elaine, I know I just saw you. I know that you get a deal at some of the hotels. I don't know if we could work something out like that. I'll take care of you. Lisa, I know you mentioned to me that you wanted to come, so we'll figure something out, man. I'm going to work with Compass next week, and we're going to put the heading underneath on the forum, Dallas or Bust, and don't stop doing what you were going to do. If you were going to help, if you were going to sponsor somebody, if you were going to lend out some home space for somebody, another trader, let's figure it out. But I'm gonna sponsor blocker rooms for the needy guys. So bottom line, you got to come down there. You got to pay for your gas, carpool. I want you guys to come, man. All right, it's going to be a good class. And if you're struggling, especially when you see it live and meet everybody, you ask questions, you talk. I know Carr's coming. I know Kim's coming. Granny's coming. Spend some time with those people and see how they're doing. But you can't be shy, man. You can't be afraid to roommate with somebody. Joe, you can't have a woman in your room unless she volunteers. I don't know if you're having like a trade affair with somebody and you want to meet somebody over there. That's none of my business, man. I can't sponsor that. We'll figure it out, all right? I'm going to work with these guys next week, getting it figured out, and we'll get the price locked in for everybody. We'll try to do the best we can. Elena, I know you work for a hotel chain. If you can help us, if there's a hotel next door that's cheaper and the money goes further, that would be great. If you can catch a ride, like maybe carpool with some people, split the gas, the room will be there. We'll figure it out, okay? But I want to throw that out there for you guys. And we'll do something like that. Okay? I think the venue is going to be the Omni in Dallas. I don't know the area well enough to say. I don't know if Kim can hear, if she's available to say, or Scott to say what's going on. But we're going to put a link up. What we're physically going to do is you just put your name and just say, I'm willing to share a room, and put you on a piece of paper. I'm going to print out the papers, cut them up, throw them into a bin. I'll draw some. I'll let Compass draw some, so it's fair. I'm going to literally do a random drawing, and whoever gets it, if you're financially okay and you change your mind, you want to go, let me know so I could draw someone else's name. All right? So it's my way of putting my money where my mouth is. I ask other people to do it. It would be ridiculous if I didn't step up also. Okay? All right, man. Thank you, Steve. Okay. All right, let's get back to the slides and see where we're at. And listen, everyone has a seat in Dallas. I just need to know so I can plan for it. That's all. Doesn't matter what it costs. Everyone has a seat, always. Okay? If you have to stand or sit in my seat, which I never sit down anyway, if you have to sit at the table with the projector, if you go through the trouble to get there, I will get you in that class. I'll put a sleeping bag in the front of the room and you can sit on it. Okay? If you make the effort to come see me, I'm moved by that. You will have a seat. I'm pretty sure the Omni's firm because I think Compass has a relationship with them. Okay, all right, man. Enough of that stuff. Let's move on. All right. Here we go. M&W, we've been talking about them. Let's break them down a little further. Okay, let me get my screen's a mess. Hold on, sorry. The clock is like blocking the slide changer button over here on the other screen. Okay. Okay, look, I didn't invent the M&W pattern. It's not mine. It's a typical 1, 2, 3 setup. You've all heard of this before. It's in the books, right? But I didn't understand it and had to see it at the certain times until the market maker guy explained it to me. This is how it was explained to me. It's the high, the pullback makes the number 2 point peak, and then the pass back towards the high or low of the day. All right, let me grab that pen. Okay, right, you know the pattern, right? 1, 2, 3. This is simply, remember the number, the price point, market maker makes vector 1, 2, 3 to the high. He pulls back off of that high, traps the traders in both directions, right? Hits the stops in here. Anybody that had orders in here, or anyone that was long in here is stopped out. Anyone that went short in here is taken out on the second leg. The second pass, when it fails to take out the high, that's our entry. This is the technically correct entry. This entry is too late in the game, man. Your stop has to be monster. Okay? That's what I want you to understand. These are the technically correct entries. And when you get like Scott, the technically correct entry is right there. Okay? Or a granny trade. Right on top of the number. Understand that this structure takes 30 to 90 minutes to build. Because it doesn't take into account V-tops and V-bottoms like when you get just this one structure right here and price goes out. Okay, I don't know if Paul, how far your restaurant is from the Omni, man, but we could all hang out over there. Paul owns a restaurant. I'm putting him on the spot, man. Paul owns a restaurant over there in Dallas. I don't know if it's a family establishment or what, but it'd be cool to go over there. He's not treating, by the way. I'm not throwing that out there. I'm just saying it's a good place to hang out if it's close. So, anyway, okay. All right, so understand, if the V bottom, that's the only thing we can't account for, that's where the 30 minutes come in. Okay, Paul, is your restaurant close to the area where we're going to be in? I don't even know. I know, Ribs. We'll talk about it next week, Paul. I'll give you a call, man, and see what we can do. I don't want you to comp anybody, but it'd be nice to hang out and have a place after class we could all go. Okay, we'll figure it out. All right, so look, here's the typical pattern I just illustrated for you, right? I'm getting off track. All right, look. That's the technically correct entry on the close of that candle. How do you know? Because the low held. Here comes your shift bar. This is when the moving average fires right here. You're late, right? When the moving average crosses over, you're late. That's why I want you to use the moving average crossover as confirmation your bias is correct and you grabbed the right point of the chart. Okay? That's what I want you to understand. Same thing, look, M formation. They hit the high, high of the day is formed. Right? Market makers come near the high. Again, they issue a nice pin. Entries here or here. Here's the shift bar right here. See it? You want to be in before they hit the shift bar. The shift bar opens the zone, creates the panic, pulls higher level longs trapped. You want that bar. You want to be in before the bar so when it makes the move, you're up 25, 30 pips in the blink of an eye. You want that to be in your favor. That's a no drawdown trade. Straight red, roll over, and he shifts the zone, you're almost to profit. That's what you want, okay? That's the most exciting trade you're going to take. When he does that and you're in that, it's like you can't even explain the feeling. It's like he comes in, you grab the trade, and in 30 minutes you're almost to your take profit. You're like, oh man, I'm telling you, it's euphoric. It's amazing. But don't be pulled into the trap that it was too easy and you have to go back and keep working. That's not the business. The business is to be a stalker, a sniper. Get in there when the second leg presents, take it and get out. All right? Don't forget, sometimes you'll have spread out vector to the low. He'll issue pins to the downside. The pins turn to the downside. He'll kind of half Batman and not make the second pass. Okay? This is as close as you're going to get to a second pass. Your job is to deal in here after he holds the low for a while. When this kind of thing happens, this is when this happens. When he runs price straight through the session to the end of the day. So let's say you're looking for the reversal at noon and it doesn't come. 10, 11 o'clock doesn't come. He keeps running the trend. This occurs at options expiry, end of the quarter, end of the month. The reversal trades are tougher to find at those points in the cycle. Because the market maker makes the aggressive move. If you notice, he did it 31st and 1st, right? Going into August. He made the aggressive moves because traders trade on a 30-day cycle. He has to punish them. Options expire, etc., that kind of stuff. He'll make the aggressive move. Now, what the half of Batman comes in is when he ends the day near the low or near the high, he will then extend consolidation into the daybreak. He'll extend consolidation into the daybreak and then continue it through the Asian, and then he may or may not stop on. He'll straight rise. If he has the trap volume he needs, you can expect a straight rise out of here because, remember, if he comes back, he releases the traders back into the wild. Can't do that. Can't let that money back out. Got to hold it. So he'll straight rise. He did it last week on, I think, EJ or something. Or it's in there. Go back and look at this. Exactly like I've drawn this for you is in there. All right, so look. All patterns that you see that are in these textbooks, they're a variation on an M and W. Flags, wedges, pennants, triangles, the head and shoulders at level 3. But what they really are is they're simply traps by the market maker, and for our purposes, I'm not insulting anybody, but for our purposes, they're worthless. They offer a 50-50 winning percentage at best. I told you in the beginning of the week, we're not in the 50-50 business. You have to understand where price is in relation to the high and low of the day, the high and low of the week, and where you are in the cycle. That's your responsibility, okay? Because flags, wedges, pennants, all that garbage, right? I always joke around about the head and shoulders. Like, if you understand what's going on, why can't you amputate this shoulder, and then this is your W formation right here, isn't it? And you know where to enter on this. Where they show you technically to enter, it's too late. I want you in tight near the low or near the high. Tight stop losses. The risk to reward takes care of itself. Money management works itself out. The reason you asked me about stop losses and money management because they drill that crap into you in the textbooks. Because they don't have a 9 out of 10, 8 out of 10 winning percentage. So they go, oh, well, if you're losing that much, you better manage your money. You know why they tell you to trade 1% risk? You can lose like 25 or 30 times and only be down 30%. It's crazy, right? That's not happening here. And if it does, something's wrong with you. You like slept through my class. And if you are having those kind of problems, I want to know about it. Okay? So anyway, all these patterns are variations on market maker trap moves. We're not in the 50-50 business. We're in the high accuracy sniper near the high, near the low of the day, near the high, the low of the week. Right, here's my little head and shoulders. Amputate, enter here on a V top or here on the pullback. Jim, is this the 1618 retracement of the high of the day, man? I had to bust his chops a little. Okay, look. Symmetrical triangles. Let's talk about that for a minute. Symmetrical triangles, great. But you know what I see in there? I see an M, I see a W. But here's the deal if you think about this for a minute. This is what the pattern represents. Okay? This pattern represents higher level longs, gotcha, bring it in. Lower level shorts, gotcha, bring it in. Higher level longs, gotcha, bring them in. Lower level shorts, gotcha, bring it in. Now they bring it in, bring it in, bring it in, right? They bring it into the middle. If you notice, each subsequent pass on the triangle does not allow the trader group previous to them to book a profit. That's the job. Can't let those guys book a profit. Got to hold them. That's why each subsequent pass is higher in nature and doesn't allow the previous group of trap traders to any reprieve. It doesn't let them out. Now, Scott mentioned this. It's like hilarious to me. The head fake. There's no head fake in Forex. The head fake is a stop hunt and a way to validate the breakout traders who trade the breaks on the pendings on the other side of these formations. Most people put pendings here, and they take it, and they get hit like this, and then goes this way. Think about what they're doing. Think about these patterns from a market maker perspective. Think about why I'm trashing them. It's not because it's fun, it is kind of, but it's because this shit doesn't work because it's a trap by the market maker. That's why you see that in the chart. Why does that come in the chart? Hit the highs, bring it down lower. Hit the highs again, but not as high as the previous high, bring it down again. Hit the high one more time, but not as high as the previous two highs. Bring in the volume, analyze. Which way is this structured? Man, I got 3 trillion net long, 1 trillion net short. Here's my drawing, always draw, right? Hit the stops of the weaker short holders, cancel them out, make them think long. Then, man, the bottom falls out of that pennant or triangle. And it is over. The long holders are the suckers for the weak. That applies to pennants, caps, ballparks, broken elbows, flagpoles, bent knees. I don't even know all the patterns that are out there. They're crap. Okay? I just want you to understand The market's choppy. Oh, we're risk averse. We have an appetite to lose our money. All right, my favorite one. That's excuses or reasons because they don't freaking understand themselves what's going on here. Okay? And the sad part is that these guys, market makers, laugh at the traders, man, and I'm sick of it. Okay? All right, man. That's what those patterns represent. There's no head fake in Forex. It's the stop hunt the other way. Right? There's some other nursery rhymes that go that the trend goes from whence it came, and there's so many nursery rhymes out there. The trend doesn't go anywhere unless there's money there. The stop hunt comes out, picks up the orders, absorbs the breakout traders that trade the breaks of the pennants or wedges, and then they punish the other way based on dollar buildup or volume buildup on either side. Nothing more, nothing less. That's the business. Okay? All right. Yeah, Deb. All right, pivot points. I had to drink a Diet Coke sip. I'm not spending too much time on it, but I'm going to give you a rough idea of how we use them for our purposes. Okay? All right, everyone knows pivot points are calculated on daily candles. I'm still trying to work out how to do the projections on the 3-day cycle, and it's driving me absolutely crazy. I might cut my ear off. Because we know that some days the pivots don't line up because we know the cycle's about to change. I'm trying to figure out how to get that to work on a 3-day cycle. Because in a downtrend, you expect red candles to keep painting, but we know the retracement's coming. So the pivots won't line up on the 3rd day of the cycle because we know they're about to reverse, but you'll get an M1, M3 projection. I'll figure it out eventually. Hopefully, it won't be like I'll have to write it in my will, and then Heidi can read it to you guys how to figure it out. Anyway, all right, look. Yesterday's price action gives tomorrow's pivot points. So that means that what happened yesterday is going to project tomorrow where the high or low might come in. Why? You know, as a trader, candles overlap, right? They don't stack on top of each other. Okay? So now, I'm going to break a daily candle down for you and explain to you what's going on inside that candle. All right, so think for a minute. Let's just use this as a candle. We know in a downtrend, the candles come in like this, right? So on a 3-day cycle, think about what's going on here. Peak formation high, down to the low of the day, back into consolidation, open, close, right? My lines are off. Let's pretend I'm a market maker. Sorry for taking your money for the last couple of years. Okay, listen. I come on at my shift time, and he tells me my targets. All right, Steve, we got build up at this level. I need you to do X and drop price. We need to continue the downtrend. We got orders built up on the high side. Okay, cool. All right, here's the deal, Steve. You're only allowed 100 pips. That's all you can move today. That's your ADR allowance. That's what you got to work with. I'm like, okay, I got 100 pips to work with. How am I going to work those 100 pips? 25 pips, hit the stops high, drop trend 75, pull back to end the day 25, and give me the close side of the candle. Now think about a candle. Okay, I come out at the central pivot point open, I break high, and I use that stop hunt for 25 pips because I'm only allowed 100. Okay, I break high, I drop 3 levels, I hit the low of the day, 1, 2, 3. Right? I hit the low of the day, form the W or V bottom, and come back and go into consolidation. That's my close. So now picture the candle. Right? The wick, I come in at the open, I rise 25 pips to hit the stops and drop. I run my level 3 inside the daily candle. I spike the low, pull back, and go into consolidation to end 25 pips off, and I've used my 100 pips allotment for the day. That's the structure of a daily candle. If you've never thought about it like that, that's what goes on in that one candle. Okay? So now, looking at the daily candles on the chart, the color red candle down day. Look at the candle at 5 o'clock New York when it closes on the chart. Will give you tomorrow's projections. We know that market makers respect ADR. They have to. It's in their marching orders. We know that they are limited in what they can do so they don't hurt the world any worse than it's already a mess, right? Any worse than it is. So think for a minute. Okay, I run the pound. I come on the floor. My job is to do pound dollar. I'm allowed 200 pips. Okay, I'm going to do the same thing, but here's an up day. I'm going to come in at the open, my candle. I'm going to use 50 pips to stop hunt because the pound's more aggressive. I'm going to make my W, which forms the wick, and I'm going to reverse 3 levels of rise to the high of the day, inside the daily candle, inside my allotted pip movement. I'm going to spike the high, come back, and close. Right? Now picture the candle that this is done in. Here's a daily candle. There's my spike to the low, my spike to the high. This is the close. This is the open, right? LOD, HOD. Okay, so now, every market maker is allotted a certain amount of movement for each pair that he's moving. That's why ADR is helpful in establishing these moves. So now, if we know that yesterday was a down day, hold on, let me get a clean. Here we go. If we know that yesterday was a down day, and we look at the pivots, we have an M1, M3 projection for tomorrow. Red candle equals downtrend or down cycle. The pivots are M1, M3. What does that mean? It means that we expect the high of the day to form at M3, seek out M1, and then pull back 25 pips and go into sideways consolidation. So for our purposes, the central pivot point is where price opens. Okay? So they come in, they run 25 pips higher as a stop hunt to the M3 line, and if there's other things that line up, if the M paints on M3 with yesterday's blue tracer, those things start coming together. He issues the candle pattern, works it for 30 to 90 minutes, comes out of a 25 to 50 pip Asian Tokyo range. See how those things start to come together? All the things I've been talking about. Now you got an M3, M1 day. He hits M3 like clockwork. Now you expect 3 levels of drop down into the M1 range, slightly past maybe, a reversal to end the day and get the closeout on the candle. That's where the pattern comes in. Picture the daily candle and draw the pattern inside that candle. Now do yourself one better and realize he has a certain allotment of pips he's allowed to move. And that's where that behavior, reversal US session to come off the low and create the low side wick or the top side wick in the candle comes in. Okay, so to oversimplify it, at the start of the London session in the winter, 2 to 3, or now 3 to 4, summertime, he comes out like this. If he breaks up, you're a seller. If he comes out like this and breaks down, you're a buyer. The other exit, the exit's a sister pivot, reverse signal, 3 levels of rise. Those are the things that are hidden inside the daily candle that you now know. That's how you find the exit. Want to know the possible range? Subtract M1 from M3 or M2 from M4. If the daily candle closes green and you're in a market maker upcycle, the projection for the low of the day is M2. Understand that M1 and M2 are possible price points for LOD to come in. Okay? You have the central line, and then M3 and M4 is a possibility where the highs of the day will be made. So now, Steve, do I get out of my trade? Do I take the reversal? It's an M1, M3 day. Market maker came out, hit the M3, painted a wick to the high, outside bar structure, half a Batman drop. But you know what I noticed? He's only made 2 levels of drop right around the M1. I'm not going to take the reversal yet because I'm waiting for one more level in timing to line up. Let me hold on for the US session. He might go past the M1 pivot, but the pattern trumps everything that I've learned because these are man-made technicals. They're not market maker technicals. This is stuff that I've read in a book that I'm trying to make fit on the chart, not the other way around. Remember, this guy makes the rules. He don't follow them. So now, he comes in at the M1. If you're not satisfied with that amount of pips, that's fine. The pattern, the pattern, the pattern. Okay? That's how we use pivot points to help project the high and low of the day in the zones. Possible highs of the day, M3, M4. Possible lows of the day, M1, M2. The reason why you got to be a little flexible in those numbers is because we know that in 3 to 4 days the cycle will reverse and the pivots will be skewed that day. The candle day before can close red, but he's at the bottom of the cycle for us, and we're at level 3, and you could make the reversal. So you switch the pivots to M1, M3, or reverse, M2, M4. Understand? If you have 3 M1, M3 days in a row, the third day, level 3 behavior seen, the pivots shift from M1, M3 to M2, M4. M1, M3 is simply the mid pivots. For some reason, prices resonate to there. Here, I'll show you. This is a typical pivot grid, right? Here's the central pivot point. That's where price comes out, usually. And you'll see your consolidation, right? Like this, Tokyo channel. Okay, it'll hang in there. It'll widen the spread to pick up the orders. It'll make a break to M3 on a down day. It might hit it. It'll drop all the way down to M1, make the V bottom, and end the day like that. That's the typical pattern. That's how it applies for our purposes on the pivot grid. Thank you, Water. Okay? So now you picture in your mind, this was based off of the daily candle. So all this went on. Missed my wick, sorry. All that went on. All that pattern went on in the daily candle. So now tomorrow, this candle's not going to be like this, right on top of each other. We know they're not like that, right? That's where the overlap in the candle comes in. Hit the stops drop. That's why candles overlap. If you ever wondered, that's why. They open, he hits the stops, drop again, spike the low, and go back into consolidation. The candles are staggered or offset over each other because he has to come out, hit the stops high, and drop 3 days in a row. Then he might issue a doji on the daily chart. He had a tight range. What does that tell us? Level 3. I see 2 down candles and a doji. I'm at level 3 in that pair, man. So now I see the scrunched up candle. Market makers holding the level, and I noticed that Euro dropped one more day to catch up to level 3. That's pretty cool. So now I know that the play's in Euro GBP. See how this stuff starts to tie together? Understand what's going on the charts differently than a regular retail trader. Okay, we're starting to tie it together. Hopefully you're getting cleared up. Okay, write this down. M3 and M4, possible highs of the day. They are located above the central pivot point. M1, M2 are possible lows of the day. They're located below the central pivot point. So if price breaks down, you expect it to settle in around M1, M2. Form a W, come back, retest the level, low retest candle, hold the level for 30 to 90 minutes. Okay, Zen, take a look at this guy, Lester. I didn't do it. See what's going on. Lester, we'll see if we can help you. Some technical issues, no big deal. If you want to know the range, subtract the pivot projections, M1 from M3. It'll give you the possible ADR. The strike zone comes in. If you got, let's picture this, a moving average lays on top of M3 with a light blue tracer, and then the ADR shows up over there. Man, you can almost bet your life he's going to strike that zone right there and fake the traders out. Okay? That's how it's going to go down. All right, let's look at more stuff. I hope that helped you use pivots a little differently and see them a little different. Here's some examples. I had some snapshots in here. Look. 1, 2, and ping to the high. Pull back, hit it again. 1, 2, 3 bursts to the low. See it? 1, 2, 3 bursts to the low. Found its way. M1, M3 day. A down projected day. Okay, the M comes in right at M3. That's called a clue, my friends. He throws a spike right around 9:30 in the morning and hits it 3 times to the M1 on the projection of that day. Then he vectors right out of there. Why? Got to get the hell out of there to end the day back in consolidation. Keep the traders trapped for tomorrow. Yes, Peter, they do. Psychological barriers. Okay. All right, look, he held the level. This was at This was a level 3 trade, right? He didn't come off of that level. He was holding the level, right? Now you know. What's he doing at that level? Working the crosses, holding the level to accumulate more orders, grabbing the breakout guys and ruining their day. Right? Then he comes right out, forms the low on M2, and he bursts out 1, 2, 3 in the consolidation right to the M4 spike in the consolidation to end the day slightly off the high. Crazy stuff, man. All right, Vincent, mark the tape and go back, buddy. I'm not going to hold up the whole class. Mark the tape. It is 9:17. Mark the tape, buddy. All right, same thing again, man. It's over and over and over again. I can't say it enough. 3 pins at the top. You don't want to give me 3 pins, man, because I'll grab that high within a pip or two. And I want you guys to practice that. Okay? It traded in a range, but between the pivot points for the day. Why? Because it's paying. This makes up the daily candle. So the daily range has been put in, so it's going to meander back and forth or bounce off the high and off the low. Right? It's going to trade off of the high and off of the low. If you think about the daily candle, it forms the high. That's our high of the day. The low of the daily candle is the low of the day. It only has one move to trade in between. Okay? Thank you, Whitney. Some people still love it. It's not essential to trade, but it's like training wheels, man, to help you see what's going on. This is exactly what Euro did last night. Go look at it. Euro came right out at the open, rolled over, and was out, went into consolidation before the news. I got out in here. Right? I got out in level 1 consolidation. Getting late for me. Bedtime. You guys wear me out. I'm tired. Okay, we're not going to do that exercise. Okay, just understand. Sorry, I had to have a sip of a drink. Pivot points are an ADR grid, right? What do you mean? If they're based on the daily candle, the daily is the average daily range of that candle. So pivot points are a projection of the daily values into tomorrow's chart. Okay? The extremes are representative of ADR's high and low. So at the extreme of the pivot grid, that's the ADR high. So M3, M4, ADR high. M1, M2, ADR low. If the actual indicator projection lines up with those numbers, it's even more powerful. The pivot grid is fixed and doesn't float, but the ADR indicator is. It takes the pip movement. So if you get a lock at the bottom or top of the chart at the range, that's going to be your point reversal for the day more than likely. Okay? But I can't say this enough. It's not in replacement of the pattern. It is in conjunction with the pattern. Okay? So if you have your ADR marker, your M1 line right here, price is going to come in and strike this as a zone. But if he rolls over there and just starts cutting the low, you don't go, oh, well, this is the reversal point. No, that's not what's going on here. It's if he comes in and behaves properly for 30 to 90 minutes in that strike zone, that's what I'm talking about. It's not instead of the pattern, it's in relationship to the pattern, how he handles that zone, okay? That's how we use pivots. If you don't like them, ditch them. I'm not going to be offended, man. But they're kind of like training wheels, okay? There are plenty of examples on the charts, man. They're pattern validation, training wheels, if you will. I have some other training wheel stuff that's coming out, but that's how we use pivots in line with ADR markers and yesterday's high-low, okay? For purposes of our method. They're also intraday support and resistance, so traders look at this and they stutter a little bit. So when you get a break of a pivot level, you're almost always certain you're going to go to the next level. So if you want to manage the trade that way, when a break plus a close above the pivot, it'll hit the next pivot. That might add 15, 20 pips to your trade. I can't say this enough. You, my friends, are the filter. You have to forget this man-made stuff that's been around. The pattern, the pattern, the pattern. It's your job to identify the market condition and candle pattern for the next support and resistance level. If you haven't figured it out yet, strongest support and resistance in the business. High of the day, low of the day. High of the week, low of the week. Everything else is crap. Oh, and don't forget the 618 Fibbo for Jim, right? Thanks, Dave. All right, I'm kidding. The strongest reversal points of the day is when the high is formed. Because the dealer says, no mas. He hits it, pulls back, no more, man. I can't go above 121.42 because I'll release the volume at 43. Those traders can book. I don't want those guys to book. So I hold the level at 41 and don't break it. Now I snatch away from there and put the longs in trouble, and I start dropping on them. That's resistance. Second leg, high of the week. The first leg hits, boom, 61.42. He comes in again at 61.40. Just misses the second high over 2 or 3 sessions. That's resistance. That's real resistance. Because it's based on money, not on some crappy lines you drew on the chart from February 1905 and think it's going to hold. The high and low of the day and high and low of the week are real resistance based on dollar build-up money. And those points are not negotiable, my friends, because it's based on the market maker's ability to trap traders and snag their cash. Okay. Understanding the pivots that big market moves will disrupt them. Okay, if you have like a 200 pip day or 300 pip day out of the ordinary and the range is 100, the pivot points will be disrupted going into the next day. So in order to find opportunity, you got to set some rules for yourself. When trading comes out on the wrong segment of the trading zone in the relationship to the pips, the pivots, I don't know what's the matter with me. Ignore the pivots and identify the pattern. That stuff is man-made by a floor trader in Chicago. I don't know the whole story on it, but we project them onto our chart and think they're magic. They're not. The pattern, make me say it again, the pattern. That's where it comes in when the pivots are wrong. Thank you, David. The pattern, if you're not sure, the pattern. And if you're still not sure, one more time, the pattern. Their behavior is the pattern. Okay, see what happens? Price comes out on the wrong side of the pivot grid. This was an up projected day. It came out, the pivots were blown out from the day before. But you know what? The pattern isn't blown out from the day before. 3 to the high, pins to the Mayo, second pass, inverted hammer, game over. I got you, you bastard. Okay, trying to trick me with blown out pivots. I see the pattern clearly. All right, good, yes, okay. All right, indicators. I'm going to go over TDI for our purposes, how we use it, and that's probably going to be the last thing we cover tonight. I'm going to take like a few-minute break, and I'm going to let Zen take it home with how he sets up for the U.S. session. Okay? Everybody good? Do we need what time do we come back? 9? Did I go past the break or something? I don't even know. I'm lost tonight. Craig, I am going to cover the shark fin in the TDI, absolutely. Okay. You know what? Let's do a 5-minute break. I'm drinking Diet Coke. I got to run to the head, all right? Let's do a 5-minuter. All right, I'm going to talk about TDI. And I don't know if I have Deb's chart with me or not tonight. I can't remember. But anyway, look, indicators and oscillators, they all measure the same stuff, right? Can you agree on that? They all plot above or below a baseline, a 0 line, a 50. If you use several of them, which one wins? How do you decide which one's the right one to go by? Why not just master the use of one indicator? For the purpose of the class, we use TDI, which is built upon the RSI line. The TDI, because of the bands and stuff, they're just like Bollinger Bands inside there. Their other average is like a 1-hour chart. It gives you some good concepts of what's going on. I don't have Deb's chart, but I have this chart. This is, I don't know, people use stuff like this and they stare at it and they keep getting the next best great indicator and hope that it's going to help them figure it out. And then they just get lost in a barrage of oscillators and indicators and they don't really know what's going on anymore. I hope you're not doing this. The TDI is built on the RSI, which I'm not going to cover. I'm going to cover the TDI itself, if I could find it. Okay, give me a second. Sorry. Couldn't remember the number of the slide. Okay. All right. I want to give kudos to Dean. These are his slides. He was kind enough to allow me to use them. I'm going to illustrate how we use TDI for our trades, for our purposes. All right, so TDI is based on the RSI. Stands for Traders Dynamic Index. I've heard people call it Trend Determination Index. It's Traders Dynamic Index. I think it's a better RSI. It gives better signals and trade confirmations for our purposes. It's a powerful tool to scale in with when used in the proper context of the market. It's going to help you build confidence in the setups because it's going to issue a signal in line with what you think you're seeing on the chart. Okay, and what's really cool is it helps you identify divergence. Divergence on the chart, if you think about it, is a stop hunt. Here's why I mean. What's going to happen is the RSI averages the closes of the candles, averages the closes of the period. The wicks are where price actually was. The damage, remember? So if price actually pushes down to here, from here, you'll usually end on a wick or a hammer when this happens. Well, that shows price lower, but the RSI won't fall for it, and I'll show you some pictures of this. The RSI won't fall for it because it'll average the closes higher, and it'll give you the signal to let you know that that is, in fact, the stop hunt. Okay, let's go through the slides. We'll talk about it. Okay, it's a hybrid indicator. Helps indicate market condition for our purposes, trend direction, momentum. We know what momentum is in the market. Don't be confused by that. And the volatility. The volatility comes in shape of shark fins, which I'll illustrate for you, okay? Typical RSI price line, you guys know what that is. For our purposes, we use a 21 period. It's preset in the student folder. Just pop it on there the way it is. It's perfect. Okay? It's kind of funny is when you look at the RSI line. Stop hunt. 1, 1, 2, and the last one starts to wane divergent level 3, and then you get the reversal. Crazy, right? It's in there. Okay, hope you guys see that. All right, so he adds the trade signal line, which, if I'm not mistaken, and Dean's going to fix this for you guys, or actually do a presentation on it, that represents the 1 hour. The moving average in there represents the 1 hour chart. So what you have is a 1 hour crossover. Okay? We know that's important because the 1 hour chart is a good base to see these patterns. Okay? That's probably the exit. You're at level 3, but it's divergent. And you'll see the pattern on the chart like this. Okay? The market baseline is very unique in this way. On a traditional indicator, the market baseline is fixed. A 50, a 0 on a MACD, a 0 on a CCI. It doesn't move. It stays there. So what happens is the market baseline comes out to greet you sooner and give you a signal earlier, several bars ahead of a traditional indicator crossover from the midpoint, which will actually help you confirm the M and W's sooner and keep you in the trade. Okay? The volatility bands help us to catch the divergence, because you will get a move outside the band and back in the band, which means the volatility is capped on the second pass. If the volatility is capped on the second pass, the market maker is bringing the spread back together. He's calming down and getting ready to roll it over. Okay? So we essentially are measuring his behaviors by using the band to notice if it's volatile or less volatile. Okay? Hang with me a minute. The volatility bands act as support and resistance based on the close, which is much stronger. Because we know the wicks are false. It's wicky or whatever you want to call it. The wicks is when the damage is done. It's based on the close. So if it's outside of the band on the first leg and inside the band on the second leg, he averaged the close is lower. Well, we know that he's pushing it up, pulling it back, getting it away from the traders. Pushing it up, pulling it back, getting it away from the traders. That is a confirmation that you're in the right market condition for what you're looking for. When the band contains the RSI line after a break, it becomes divergent. Most often, this is in fact the stop hunt. When it's viewed in the proper context, the TDI picks off the stop hunt, scale ins, and exits. Let me show you some examples. Okay, here's your consolidation, right? I had to stretch this out so it looks a little different. The first pass to the high, it's out. The second pass to the high, it's in. But there's the formation. So when this breaks back in, you know that this is the right segment, leg one, of the formation. And then the fact that price comes back to the level and TDI is gone, that's divergent. So you have the bands confirming the volatility, the aggressive move towards the high. You have the pattern presenting perfectly, by the way, at a pivot point. You have them ending on a hammer. TDI is divergent. The channel is 58 pips, but we know if we redraw it, it's like 20. Right? Let's say half of the channel, it's 27. See it? And you have your pushes, your vector to the high. 1, 2, 3 moves up. They snatch it away. They work it, 30 to 90 minutes. They go back, issue a hammer. You're in. Steve, did I get it right? Let's see. TDI went out, came back in. TDI is divergent. The RSI already left the station. It's averaging the closes down. I'd say you got it right today, my friends. Those are part of the signals. So now, a shark fin short, it sets up like this. The bands are tight, which represents the Asian range being tight also. Okay? Tokyo channel's tight if the bands are tight. The RSI line breaks outside and comes right back in. It appears as almost like a shark's dorsal fin is coming out of the water. That's why my bands are blue. The fin goes back under the water line and crosses the signal line, which is red. We say there's blood in the water to help you remember the trade. Okay, let's have a look. All right, look, this is it. This is a nice 31 pip range. All right, look at the shark fin right there. There's Jaws right there. I'm losing it, right? I've been teaching too many days. Okay, do you see it? There's your vector to the high. There's a nice, there could be 2 pushes inside of this body and maybe the third ping to the top, my favorite. Am I losing it or what? All right, look. They hold the high of the day. Right there, it's beautiful. They tap it, they come back, they issue a hammer the other way. The hammer the other way takes out the traders that got it right. Yeah, no, too many Diet Cokes, man. They make the second pass, they open the spread right here, and then in one swipe, they shift the zone. The shark goes back under the water. There's your signal confirmation that you got it. He consolidates and rolls it over. You got it today. Okay? That's a shark fin short. And obviously, the criteria is inverted for a shark fin long. Okay, look. There it is. There's your 1, 2, 3 to the low. Remember, 1, hang out, 2, 3. Okay, he breaks 37 pip Asian range, Tokyo channel, picks up some breakout orders just to mess with people, ruin their day, picks them up on both sides. He drops 1, consolidate, hit it again. Got it. I need to get out quick, railroad track, get out of there. All right, there's my shark fin. Back in the water is part of the signal, and crossing the bloodline is part of the signal. You know you got it today. He consolidates, and then he moves out of the range. Why? Get the hell out of there. I collected my contracts. I validated this. For the traders, angle and separation inside the band, nice. Okay? Shark fin long, shark fin short. Simple. Something crazy too when you look in the TDI, you start to notice this stuff, it's neat. Shoulder, head, shoulder. This entry's late, okay? Just want you to see. We enter on the railroad tracks to the low. Stop loss goes right here. Entry's here. And you can still enter here, but it's late, man. I want you to deal right after the railroad tracks. Yes, it is cool. They're in there, man. Okay, shark fin long. Same criteria as short, inverted. The setup must coincide with the other stuff, man. The TDI is a confirmation of the pattern, not the other way about, okay? It's got to be in the right part of the market cycle. If you get a shark fin at 2 in the afternoon, it may or may not pay out. Don't chase it. If you get a shark fin at 3:30 in the morning, that's solid gold, my friends. That will pay out. Okay, let's look at one or two more examples. Help you guys. Here it is again. All right, look, 21 pip Tokyo channel. Market makers widen the swing right before the session, pick up some long breakouts, pull them back. 1, 2, 3 over here. Ah, sneaky little bastards. Right? They hit it, hold it for 45 minutes, hit it again, pull back. There's your shark fin, signal cross, back, blood in the water, he's back under. Shift the zone. You got to be in and get the hell out, right? Shift the zone, level 1 consolidation. Hit the stops, hit the stops, hit the stops, rise. Hit the stops, rise. Reversal's coming. TDI just so happens to be divergent again. Right? Look. 1, 2, 3. See it? And you can almost argue this. 1, 2, the divergent leg makes 3. Okay? 3 levels of rise. The third leg is most often divergent because it's aggressive towards the high or low. And it's the opposite signal, right? If you're divergent here, or let's say you get some divergence over here, and then he comes back inside, divergent on the other end of the spectrum. Why? Market maker ends aggressive. That's why divergence shows up. Now that you understand the context of divergence, the second leg has to be issued after the divergence. That's how you use it the right way. Because I've heard people say, like, oh, I trade divergence, but you got to be careful. It can go 500 more pips on a big chart. Yes. But if you understand the market maker cycle and can pick off divergence using the TDI, you count 3 levels of rise and the price gets divergent and he starts pinning to the top, you got it. That's the reversal for today. Okay? And I can tell you Dean has some other nuances he'll cover with you, but when TDI gets way overextended and then the pattern presents, that stuff usually pays out, man, easily. And it's his indicator, man. I'm not going to steal his thunder. The guy developed it. But for our purposes, this is how we use it, and he's going to discuss the nuances with it. I think he calls the fins hooks, but it's the same thing, man. All right? It's a very good indicator for the way we use it. It's perfect for our purposes here. Okay, look. This is shark fin hold the mayo. It's not a sandwich. I know you thought that. Hold on, I need a sip. All right. What happens? You get a shark fin in and out, right? Same thing, 27 pip range. Remember I told you that at 3:30 in the morning, if there happens to be a mayonnaise line laying there and a pivot point, an ADR, these areas represent the strike zone. These things starting to come together. There are a confluence of events on the chart that just show up out of nowhere. All of a sudden, the moving average happens to be laying there. This happens usually in day 2 because day 1, remember the cycle? Day 1 comes as a market surprise and catches the retail traders going in the wrong direction. Day 2 of the cycle, after reversal day 1, you get stop hunt low drop. Stop hunt drop rise, right? Stop hunt low rise. Here's what happens. The average is crossed over and they might come to rest around or near the mayonnaise. So what happens is, this is shark fin hold the mayo. You got your shark fin right there. It's held as if to show resistance or support by the mayo. There's your pins, but that's the W formation with the shark fin out of the band and back in. He quickly shifts off the zone, goes into consolidation, repeats the level, does not take out the previous low because the average is rising, and then it's lights out right through the session. Okay? And then again, you can argue 1, 2, 3 in the TDI. Kind of crazy, but it's in there. All right, so that's shark fin hold of Mayo. It's simply where price is supported or resisted by mayonnaise, which is the 1 hour chart. Why would the market maker break and close below that? You know the answer to this because people fall for it because it works. Right? Then he pulls back and he breaks and closes below and he shows the red candle. Well, you know the bottom of my chart's cut off. I'm all right, I see it. I'll try to write a little higher. Sorry. You know that people fall for the crossovers on the 1 hour chart, so of course he's going to fake there. And when he makes this candle red, if you're viewing this on a 5-minute chart, you might have 2 closes on a 5-minute chart, which make up the 15-minute candle, right? There's 3. You might have 2 red closes down, and then the last 5 minutes or 3 minutes of the chart, he'll snatch that back and issue the hammer. That's what I was going to tell you, too. I forgot I wanted to mention. I need to make a slide for this in the candles. There's a thing called the backside of the hour phenomenon. You guys may or may not have heard of this. It is true. Watch it on the candles. The market maker will come near the low and hold a candle, let's say on the last 15-minute candle after 45 minutes of the hour, he will hold that candle to the downside, solid red. Let me draw it for you, okay? He will do this. Let me find a nice hammer. Okay, let's just say that, if you can see this hammer right in here. All right, let's say that, okay, repeat this. The backside of the hour, that means the clock, an hour, H-O-U-R, okay? 1 hour, the backside of 1 hour. We know that the 1 hour is broken into 4 15-minute candles, okay? And this is true. It's crazy. It's a nasty trick. Here's what they do. Right here at the stop hunt, let's say that this happens to be the last 15 minutes of the hour before it closes, like 1, 2, 3 before, right? This is the 45 minutes leading up to it. So he'll hold the candle at a level, and then at 10 minutes till the hour, like at 9:50, like right now, it's 9:50, this candle will be pushed down solid red. And he'll hold it there and hold it there near the low, and what that does, he'll open the spread, he'll absorb the orders on the other side by holding the candle down there, and then in the last couple of minutes of the hour, he'll pull it back and issue a hammer. So what he'll do is like almost like pull your pant leg up, and you'll end up in a hammer or some type of wick to the bottom. That is on purpose. That is not the traders, the bulls and the bears duking it out. That's crap. The market maker goes in there, pushes the level down all the way solid. If it's 9:50, he'll hold it till 9:57, 9:58. And then in the last 2 minutes, you'll see the 1 hour candle snatch away and show all wick. The traders that were trading 15-minute charts, 5-minute charts, or faster time frames saw multiple red closes to the downside. That behavior induced them to take it short, and then they issue the hammer in the last couple of minutes on the chart. And then, like I said, when you see the hammer, damage is done. No, good question. Do market makers look at candles? No. They look at where the orders are. But because everyone that trades has read those books that are out there, it's like easy for them to go down and pick up the orders. When you see the candle close, they already got the orders and they snatched them away. It's too late. The pain has been administered to the retail trader level and some of the hedge funds that don't know what the hell they're doing. Those guys are already in trouble, man. When the hammer's issued in the last couple minutes of the hour, it's too late. So what I'm telling you is, if you're making a decision based on a candle that's about to hit up on the hour, wait for the next candle to open and see how they issue at 00 on the clock, okay? That's the backside of the hour phenomenon. And it's true, it's real, they do it. No, Sean, The question is, can we see what the market makers see? No, they don't allow that. Volume doesn't work. There's no way. I've thought about it for forever. I don't know. If someone else knows, tell me, because I don't know. Yes, they open the spread down there. The bid and ask open up. You'll start seeing this stuff. Start putting those lines on your chart. Zen's going to help you guys. Okay, Zen, your email's bouncing. Maybe it's full. Check it, please. All right, so scaling in with TDI. Okay, here's some things that have to happen. You got to be in the right segment of the market. Price is still in the channel. Tokyo channel. Asian range, market maker spread. RSI line breaks outside the bands as a stop hunt. It sets up for the fin, right? The reversal's imminent. Look for the signals in the setup. You enter the trade, your stop loss is 23 pips above the HOD, right? Safe entry, lazy man stop if you don't want to hang around. Now, as it starts moving through the grid, you add to the trade at an MB break. The MB is the market baseline, the liquid 50, remember, the gold line. You add again at the volatility band break because you're getting trend acceleration, right? Here's what it looks like. You can exit all units when the volatility band calms down because you're going into consolidation. So here's how we use it, okay? 28 pip Tokyo channel, beautiful. All right, you get your vector to the high. Guess what that is? Mayo. Shark fin high, hold the Mayo. Okay? It breaks back inside. There's your entry. It breaks the market base with angle and separation nicely. Add. It breaks outside the band in the segment. Add. Price comes to rest and goes into consolidation. Hit the stops, hit the stops. The pattern can take over. 1, 2, 3. Or this is, when you look at this, it always cracks me up because this is 1 in the morning. This is 9 in the morning. When the hell are you guys going to sleep? When we're looking at a chart in hindsight, it's easy to go, Steve, I got in here, and I got out over here, and then I went and jogged around the house and took my wife to lunch. That's not realistic, man. This is 15 hours. Okay? So realistically, you got 28 pip channel. Market makers break out past the pivot point. Shark fin high held by the mayonnaise. You come back in. They issue you 3 signals. You add to the trade, add to the trade, add to the trade. It goes into consolidation, going into the U.S. session. You take and go to bed on all 3 units. That's realistic. That's overnight trading. Okay? Starting at 1 in the morning and staying until 5 when you've been up all day since 5 is BS. You guys ain't going to do it, man. All right? I'm not saying that you wouldn't try, but you're going to kill yourself. I'm going to see your obituary. David Gion made 5 million pips, but he is now laid to rest because he never took a nap. All right? I don't want that to happen to you. Okay. TDI offers a few key points to scale in. After entry is made, add to your trade on a market baseline cross. Add again on a volatility band break in the right context. Exit all units on a return back from the volatility band, just like I showed you. But here's what I'm talking about. If you get a shark fin and you add to your trade, you're going the wrong way, man. It has to be when the trend is running to break outside of the band. You don't just add because, oh, it broke out of the band. Steve said add another trade. Yes, David brought up a very good point. More lots, not more hours. I know that you've been afraid to add contracts in the past. That should be gone right now. You should have a calmness about the business. You should be refreshed and renewed and know that you are going to be right in your assessments, and it's no fear to add multiple units to your trades, okay? Correct. More contracts, more accurate picks, M&Ws at the right timing. Add contracts, call it a day. Very good. All right, this was sent in to me by Masood. This was a trade he actually took. Look, shark fin high, hold the Mayo, pass the Mayo actually. Right, you have your 3 pushes to the top. You have your vector in here. 1, 2, 3, right? There's your little ping. Got to make that noise. It's kind of funny, but when you're, I guess I'm bored at night. I don't know what the hell. What do? You're staring at the charts all night. You make up stuff. Look, they extend the high quickly. They pull back. Remember, they hit it again, and they close the candle green. Then they open, and they go right above the high and tap it. Grab the orders, and they immediately get out of there. This is a railroad track version, right? This is an extra 15 in there. That's a 45-minute structure. That's in our window of working the high. First entry scares you a little bit. How do I know it's still good? The high of the day still holds. Okay, notice that the light blue tracer is in the picture. They worked slightly above the high for all the Joe Ross guys to get in. Break plus a close showed them about 7 to 10 pips profit and then said, just kidding around, Joe, you're out. Okay, they issue the hammer and pull back. You got it. Now look down here to TDI. TDI gives you the shark fin, blood in the water, entry, scale, scale, exit. Okay, now check this out. Look at the TDI line. Let me clean this off. Okay, look closely. I'm going to highlight the TDI line first. Look, looks like a lightning bolt. Everyone know what that is? 1, 2, 3 to the low, reverse back inside. Holy crap, Steve, it's in there. And then look, divergent on the second leg, right? Isn't that divergent? Okay, see it? Boom, boom, boom. Okay? Craig, I'll talk to you about it. Subio, what? A very consecutive scale-ins. Yeah, they're conservative. They're like your scale-ins for 1 million pips. No, we have an algorithm in there. You guys have it, but I got to be honest with you. I'm still fighting with this leverage stuff. I don't have it all worked out in my head, man. This is like crazy to me. So we'll get it. We'll get it squared away for the U.S. guys. You guys overseas, man, just keep going. All right. And then you want to see something even crazier? They come back slightly past the level. Look, but TDI doesn't fall for it the next night. Look in the chart. Boom, boom. It's going to rise. There's a big fat W where they come in. This is the weekend coming out of Sunday. All right, look at TDI. It finds support in both instances. TDI finds it on just the 30 line, right? What does that mean? It means that an average of the closes is still staying here, but this is divergent, right? This whole structure is divergent. For our purposes, that forms out a big fat W, second leg stop hunt lower, to make the traders chase it down because the cycle is turned over down. So now it's time to put the brakes on and screw these guys. Okay, here it is again. Okay, I'm almost done. I know you guys are getting tired. Zen's going to go for a little while and talk to you about the U.S. setups. If you don't want to hear it, you can go to bed. If you do want to hear it, if you're a U.S. trader, you hang around and he'll get you straight on the U.S. stuff, all right? Look, this is the exact example of why you don't move your stop into the zone too early. Market maker comes back to pick up anybody that moved it too soon. See it? And with the spread, it actually went almost down to there. Okay, so look, you get the nice formation, right? You see it in here and here. It comes back, blood in the water, shark fin, take your trade in here. You can scale on the break. You get the pullback, don't panic. How do I know this trade's still good, Steve? By the way, it's laying on a pivot. How do I know it's still good, Steve? The low was not breached on the return. Okay? 1, 2, 3, there's your levels. A nice straight rise. And then it goes into consolidation coming into the U.S. session. You can exit and go to bed. That's realistic. This is a realistic cycle. And you can take a typical 50-pip run, do a 50-40 and a 20, or 50-30 and a 10. Maximize your gain. Call it a day. Jennifer, send me an email and I'll talk to you about it, okay? I'm not going to take everyone's time up for that. I'll be happy to help you, though. You have my email address, right? Okay. All right. So good. All right. Let me see. Same thing. This is it with railroad tracks. Boom. All right. And then this is same exact thing. Look, don't you see these charts are old, man? These charts have been on my slide for the last 6 months to a year. Some of them are updated. But understand that you take a typical 100-pip run right down to the U.S. session. There's your exit, right? It goes into consolidation, railroad tracks. You know you're out here. Take 114, a 95, and a 75. You take a typical run because you've identified the market maker. You could scale without fear. You know what he's going to do, right? He comes right out. He shifts the zone off of the high, hit the stops, drop, hit the stops, drop, start hitting the stops to the downside, trap and control, reverse back into the range. That's your exit. you scaled in 3 times or 2 times in addition to your regular trade, and you've taken a 100-point run and multiplied it into 200-300 pips. Okay? All right. Good stuff. I think I'm going to end it here, man. I'm going to take a couple of questions. I'm going to let Zen talk about trading this stuff during the U.S. session. I don't know if his wife's available. Both of them are going to be here, or him. Not sure yet. But either way, it doesn't matter. You guys need a break or just keep going? I know you're tired, man. I know you're sick of me. You're tired of listening to me. It's a lot of material. That's why you got to come back. That's why we need for you to come to Dallas and repeat. Okay, I'm glad you guys are not tired. Thank you, thank you, thank you. Everything's going to be recorded, man. Everything's recorded. Okay? You need 5 minutes for a drink, 5-minute break. Sure, let's do a 5. You know I'm drinking, so I could use a break. All right. I know it's Friday night, man. I know your family's probably rolling their eyes at you. They want to go out. They're probably waiting to go to dinner. But let's do a quick 5-minute break. All right, look. I'm going to just hang around, let Zen do his thing. We'll take some questions at the end. We'll talk about some stuff. If you're like totally blown away and lost, try to make it to Dallas. And hopefully you'll hear it again. Don't forget, the recordings are up. What you need is, I guess a good formula would be take tonight off, take tomorrow off, take a couple days off, and just let this soak in, think about it. And then Sunday, try to meet up if you need help with the forum. You need help with any type of login stuff. You need help with the platform. Do that Sunday, and then just like you need a couple days, let this stuff soak in, man, because it's opposite of what you've been doing. That might be your sticking point. You might struggle with that. So just take a little time to yourself, spend some time with your family. Stop thinking about trading for a couple hours, couple days, whatever it is, and just let this stuff just soak in a little bit. And then come back and listen to the recordings for the next 2 weeks, on and off. Take notes, organize your notes, spend some time, that kind of stuff. Typical educational things you need to do. Spend some time notes. Make notes on your notes. I want to go back to listen to this section. I'm a little confused here. I got lost in fractional disparity. If you're totally lost on that, don't worry about it right now. Scratch it. It'll come. Remember I told you there's an order of importance? The pattern's the number one order. Practice identifying the pattern, that kind of stuff. Okay? All right, I'm going to turn it over to Zen. He's going to go about, I don't know, an hour or so, 45 minutes, around 11, and I'll say some final words to wrap it up, and I hope to see all of you in Dallas. If you're leaving now, thank you for being here, and I'll see you guys in about 45 minutes or so. Zen, you're up, buddy. Thanks.
I go ahead and go into this particular segment. There's a couple of house cleaning things that I just want to clarify while we got everybody here. The Sunday night sessions will start at 6:30 Eastern Standard Time, and you will get an email 24 hours before and then an hour before. That's how the system is set up. So those of you that have submitted tonight or this morning for approval, all that stuff will happen tomorrow. With the class going today, none of that was touched. So I just want to clarify that for you. The second thing is that last night we had Carr, Kim, and Granny cover the daily market review sessions for us, and they're doing an outstanding job. I just wanted to clarify, these are some of the top students that have learned from Steve, and this is something that's being done outside of Steve's business, us here at Market Makers Forex. This is something in addition to it. It's for those that are interested, we've had nothing but praises for these guys. They're doing a fantastic job. But because their time is valuable and they're not employed or partners with Steve, it's something that's separate. If you're interested in that, the fee is just $75 a month, and that's optional. It's not something that's required, but it's something that will help you if you decide you want it. However, after the recordings go down at the end of this class, which is on August 22nd, you're going to get a free week in there, and if it's something you like and it helps you, pay the money. If it doesn't help you, that's fine. You don't actually need it, but if you want it, it's available, and we wanted to offer that to you. So if that's something that you're interested in, you can email Carr for an invitation. That would be at Fractal, Fractal, Pips, P-I-P-S, at gmail.com. And if you look on the screen, the email will be up there in just a moment. So I just wanted to make sure you're are aware of that. The next item of business is we're going to repost a new student folder. It's the same, but this one's been downloaded hundreds and hundreds of times. So we just want to make sure that it's fresh and clean. That will go back up on Monday. And then again, the class that we have coming up September 24th through the 28th, that's going to be in Dallas. We're just working out the fine details. Scott will have the information. We're hoping around the middle of the week, maybe Wednesday. As soon as the information is in hand, we have the button or the code or whatever to get the discounted room. That's going to go out to everybody. Okay, and then finally, a lot of people have asked, "Hey, how are we able to learn this information?" Let me just tell you what Diane and I did before we talk a little bit about this. And here's just a recommendation. This worked very well for Diane and I. It may or may not be good for you, but it worked well for us. The first thing we did is we took a notebook and we copied down verbatim every single slide that Steve put up. Didn't listen to anything that he said. We just verbatim wrote down every single slide. Then the next thing we did was, as we went through the recordings and being around Steve and his teachings, I didn't write anything. All I did was listen to what Steve was saying. If he threw out a nugget that I thought pertained to that particular slide that I had previously written, or he helped clarify something, then both Diane and I wrote our notes on that. And then what we did was both Diane and I individually took all these notes and we restructured them in a way that made sense for each one of us individually. Now, let me tell you, this takes a lot of time. It took many hours to do this. And then when we finally were done with that, the next step was, well, most of you know that we're from Nevada, and we go back and forth between Florida and Nevada up near Tahoe. Last summer, we drove out and we had our family out there, and we just, as we were driving back, Diane and I really thought we knew this method. I've been around, you guys got to understand, I've been around with Steve about nearly 3 years now, Diane and I have, so I know him pretty well, and I thought that I really knew the method inside and out. So what we did was we actually took our notes and we turned them into a test. And so I'm going to test you here in just a minute to see how well you are, but that's what we did. And then 3,038 miles, or however long it was, we quizzed each other all the way across the country to make sure we understood this. And then outside of that, the next thing we did, and we had been doing this for quite some time, is we went back in the charts and we marked them up like Steve asked us to. So just giving you some ideas. If you really want to know this inside and out, that's what you're going to need to do. Okay? So let's get started. I have a couple questions for you just to kind of see where you're at. And then we'll move into this particular sheet that we have in front of us. Here's the first question. What is the only way to beat the market maker? I'll give you about 15 or 20 seconds. Go ahead and type in your answer, and we'll see how many of you are correct. What's the only way to beat the market maker? Baseball bat, that would work. That's kind of funny. Excellent. This is good news. Steve, you're doing a fantastic job because they're getting it. That's right. The only way to beat the market makers is to trade in line with them. Now, let me back up for a moment. Diana is not sitting here with me right now. She's with our kids, and most of you know that she is a much better teacher than me. She's a fantastic teacher, but she's a mom first, and so she's with our kids right now. If they fall asleep before I'm done here, then she'll come out to say hi. But she's already committed to going to Dallas, and she is really excited about that. Looking forward to seeing everybody there. So anyway, so Steve, you did a great job because you see the answers there. Looks like yes, you need to trade in line with the market maker. Okay, next question. What two emotions do the market maker use to prey upon traders? What are the two emotions that just crush people? Excellent. Excellent job. That's right. Fear and greed. Correct. Correct. Next question. What level of the count is not market maker driven? So Steve taught us the counts, level 1, 2, and 3. What level is not market maker driven? Excellent. Correct. It's level 2. It's very good. You guys are doing excellent. Okay. Now here's another question for you. Typically, what two levels show the most aggressive moves? Typically, what two levels show the most aggressive moves? Very good. Correct. Level 1 and 3. Next question. What time frame chart is easiest to see the levels? To get the overall picture of what's happening, what's the easiest time frame? Steve, it looks like we've got some straight A students. We got a lot of people getting this. Excellent delivery. The best time frame to see the levels is on the 1 hour. Okay, typically, and this is typically speaking, how many swipes do we see at either the high of the day or the low of the day? Excellent. The answer would be 3. Okay, good. How long should we see the market makers working the high or the low? How long do they generally work the high or the low? Excellent. 30 to 90 minutes. That's correct. Okay, next question. A look at larger time frames for a bigger picture to determine which pairs the market makers are working on any given trade. What's that called? Kind of a trick question. I don't think Steve really covered that, but aha. Kelly's got it. She's been around a while. It's called a macro view. It's a bigger picture. It's a macro view, and we're going to cover that here in a moment for you guys to help you kind of get tuned up to this. Next question. A study of the 15-minute chart to obtain market maker pricing for entry is called what? What kind of view is that called? Yep, Kelly got it again. There's a lot. Okay, good, good. Excellent. Correct. That's called a micro view. Okay, now I'm going to ask you just a couple of more advanced questions. Now, guys, if you're getting most of this information, great. If you're 50-50, guess what? You got a little homework to do. Doesn't mean that you can't get this. Just means that you have to study your notes and go back through the recordings. How do we spy on the market makers? What do we use? Sean's got it. Nikeo has it. Very good. Yeah, Mike's got it. Excellent. What we use is technical analysis. That helps us to spy on them. What's the most powerful move in Forex? And Steve covers this. He teaches this. Excellent. It's a 513 cross on the hour. Very good. You guys are getting this. Excellent. Okay, a couple more questions here and we'll jump into the presentation. What are the 3 market maker method entries? What are the most common or the safest entries that Steve teaches us? Okay, some of you are getting this. Okay, some of you need a little work here. Number 1 is peak formations, right? That's the stop hunt out of consolidation. We're watching for the 3 swipes. Next is the straightaways out of consolidation and third level shifts. Okay, good. There's a lot of you that are getting it. Excellent. Guys, understanding and knowing these things are going to help you with your trading. You've got to understand the full picture. You're dangerous right now if you're batting about 50%. Do some more study. Okay, next question. What are the 3 market conditions? What are the 3 market conditions? 3 things that the market does. What are they? Kelly's doing her homework, man. She's got it. If anybody needs help, call Kelly. Just kidding. Excellent. Consolidation, accumulation, stop hunt, and trend. Very good. Okay. Next question. What is the safest stop placement? A, and the B side of that is what is acceptable based on entering a trade. What's the safest? What does Steve teach us? Booyah. That must be a foreign language. Okay, excellent. Excellent. You guys are getting this. The safest stop placement is 23 pips plus the spread, above or below the high of the day. Now, what's acceptable? When you get good, 7 pips plus the spread. Excellent. Okay, here's another one. What are the 3 types of take profits that you can use in Steve's Market Maker method? What are they? And guys, you know what? I would encourage you to go through notes and make up your own tests. These are things that are critical to your success. You need to know these things. What are the 3 types of take profits that you can use in the Market Maker method? Okay, the answers are slowing down a little bit. Okay, the first one is fixed, which an example of that would be like 50 pips. The second one would be projected, and a good example of that would be like an EMA or a pivot. and the third would be stop-based. Okay, here's we'll stop at this question. I want you to name 10 of the components that Steve uses on the chart. So an example would be, I'll give you one for those that don't know, the EMAs. So I want you to add 9 to that. Type them in there. What components has Steve given to us on the chart? Indicators would be another way to look at it. Components or indicators. Okay, Dak's got some there. We're talking about what are some of the things here that are used to help us. Steve gives us a whole basket of stuff to help us. These are things, guys, that you need to know. Okay, I'm going to give you a couple more seconds here. Jurgen, very good. Bruce, very good. Jerry, very good. Don. Okay, let me give you some answers here. The EMAs, candle patterns, M&W formations, the color-coded sessions, which represent the U.S. or the Asian sessions, stop hunt zones, the crossover arrows, the previous day high-low marker, pivots, TDI, the level counts, ADR marker, strike zones. There's many other things. Okay, listen, guys. Just again, go through the material and learn it. If you think you're just going to come through this class one time and not study it and take notes, your success probability is pretty low. It's going to take some work. Trust me. Everybody that is a student of Steve that has gone from A to B in terms of doing the assignments that Steve has given them, they're successful. If you want to be successful, it's going to be no different for you. Okay, so let's go ahead and get started here. My wife, Diane, and I, most of you know or have heard, we have 6 kids. Now, they're not all small. 3 of our kids are grown up, and we have 3 left at home. And they're very active kids. We have a daughter and 5 boys. And the sons that are left at home are 12, 8, and 9. And we decided, Steve last year was telling Diane and I and Diane's brother Dennis that, he was always talking about how there's pips around the clock, and I was just like, you know what, let's really see if there is. Let's just really see if there are that many pips. And so for 3 days last summer, my wife and I and my brother-in-law, we pretty much hit it around the clock and traded as long as we could, and just absolutely, we crushed the market, but we were totally wasted. And one of the things we learned from that is, you know what, there truly are pips all around the clock. Steve prefers the London session, and you know what, Steve kills that session. That's part of his life. He loves it. But with us having 6 kids, 3 left at home, that's just something that didn't work out for us. We couldn't do it and still function as a family. So we decided a little over a year ago that, you know what, there's enough pips during the day. We're going to figure this thing out. And with Steve's help and guidance, guess what we did? And so, Steve, I'm very grateful and appreciative of the things that you've done to help Diane and I and our son, Kanan. I can't express my gratitude. You know that, buddy. So the days that we trade, we never trade Mondays, rarely trade Tuesdays, but we like Wednesday, Thursdays, and Fridays. Those are the days we trade. We drop our kids off at school in the morning, and we come back, and I start looking at the charts about 8:15, and we run through some track downs, which I'm going to do with you in just a couple of minutes, and then show you some examples. And we are normally wrapped up by about 11 o'clock. Or 12 o'clock sometimes at the latest. And here's the deal. If we don't see a crystal clean setup, I'm over it. We pack it up. I turn the terminals off, and we walk down to one of the restaurants downtown here, and we go to lunch, and that's what we do. Now, a year ago, that was really hard for me, man. Every day that I came to the terminal, I felt that I had to trade, and I did, man. I had 8 or 10 trades going on all the time, and it was insane. And it was very, very hard to manage, and it's hard to make money, at least for me, doing it that way. Now, some of you guys are asking what time zone we trade in. We live in Florida. We live about 40 minutes from Steve most of the year, and then in the summers we head to Tahoe because that's where we're from. so we trade West Coast time. Okay, so first thing that we do is we do a macro check down. Now, a lot of you have asked how many pairs we trade. In the student folder, Steve lines you out with 9 different pairs, and that's fantastic. For Diane and I, we look at 21 pairs. And if you look on the chart here, these are the pairs that we look at. Do I trade every one of those pairs? No. I trade the ones, and it honestly doesn't matter to me. My mindset is I trade the guy that's going to pay me. If there's a nice setup that I like, that follows the patterns and things that have been taught to me by Steve, I take the trade. If it's not there, I get up and walk. So let's just kind of go through this. As you can see, all the pairs are alphabetized here. Down at the bottom, these are the majors. The reason we have the majors down here, Steve and Scott both taught you about fractional disparity. I'm just looking for another clue to help me have a higher probability of winning my trades. So I highlight the one that's the strongest, and then I circle the one that's the weakest. So, and again, I'm not going to go into that because we don't want to keep you all night. I'm going to spend maybe another 10 or 15 minutes, and then I'm going to turn it back over to Steve. But anyway, that's what we do with that. What we do here is, and I'll show you some examples. First, I'm going to walk through this particular sheet. Then I'll walk through the micro. Then I'll show you examples on the chart. But here, I'm looking for the level. I pretty much only trade level 3 trades. So what we're doing is we're looking for activity. If I see level 3 activity, I'm going to write a 3 right in here. And then I'm going to draw an arrow to the upside or to the downside, depending on which way it's going to go after it finishes that level 3 and turns into a level 1. My spread is always really set. I count every one of them at 7. Some are 2 or 3. Some are a little bit higher if I trade GC or something like that. But that's what I count just for easy math. And then whatever for us, I put the stop loss. I'm sorry, the stop loss is 7 plus the spread. So if my spread's 2, and I add 7 to that, it'll give me a total stop of about 9. What I'm doing here in this particular box is I'm looking at the trend, and here's how I'm determining trend. We're taking the 50 and the 200. If the 50 is above the 200, then it's an uptrend. If it's below it, then it's a downtrend. And then I put any kind of notes that I have in here. And if you're wanting more detail, if you go into the forum, you look under the U.S. session, there's some of these forms that we've done that are filled out, and hopefully that'll explain it to you. If you have more questions after you've reviewed that, then just shoot me an email. I'll be happy to answer your question. So this is the first thing I do, is I'm looking here and I'm determining which pairs that I may want to trade, and it's usually 7 or 8 pairs. Out of the 21 here, it's usually 7 or 8 pairs that I find interest in that particular day. Then I pull up this sheet here. Oops. And this is what we call our micro. And what's going to happen with you is, as you study and learn this stuff from Steve, I for months have not really had to look at this because I do it unconsciously now. I know exactly what I'm looking for, so I don't need a checklist anymore. But here's an idea of what we look at. I check the TDI and see where it's at, overbought or oversold. I'm looking also for shark fins. I want to see if the pattern in the London session stop hunted. I'm looking at the behavior that it displayed prior to me coming to the terminal. Also looking at the pivots and seeing how the London session has played out. Looking for diversions. Steve, the strikes to the high and low, we talked about that. I'm also looking at the ADR to see how far it's already run, and I'll show you how I do that in just a moment. And then I'm also looking for the 1 hour 513 cross. And so what I'll do is I'll take, if it's EJ, I'll write EJ here, and then I write my notes and see if any of this stuff has occurred. If it's AJ, Euro, the cable, whatever, I write them in here. And then I put a check or write, my different notes in here to help me funnel down or sift down to the trades that I think are the best. So let's go ahead and look at a couple of pairs, and I'll show you exactly what I'm talking about. Got a few here that we can look at. Okay, so this is AJ. So what I would do is I would look up here and say, okay, coming out of the Asian session, this really had three swipes to the high. There's 1, 2, 3, and then it faded away. So I would measure from here, the top of this candle, down to the bottom, and see what kind of run it had. Most of the pairs, because I've been doing this long enough, I have a really good idea of what their daily run is, or what their average, what they're doing daily. So if it's within 10 pips or so of what it normally runs, then I'm totally looking for a reversal. So on this pair here, do we see any signs here that this might be a trade? Okay, so from here to here, that looks like a pretty good long run. If you see right here, it averages about 120 pips a day, and you can see right here that it already ran 128. So it's basically ran its limit for the day. So I know it's going to return. So it comes down here, went up, and then it retested down. What does that teach us? What Steve taught us about that? That's a W, right? And you also see a W right here in TDI. So let me show you a marked up chart of that now. Okay. So here's what we're talking about. Here's the first leg of the W, right? It came back down, retested. So my entry is right here. I can see here that it retested. I'm looking, there's a W right here. I should have marked that for you. There's a W here. So as soon as, for me, now a lot of people can wait until this candle paints, but for me, man, as soon as I see that headed up, that's my entry. One of the criteria for the trades that Diane and I make is I'm always measuring. It needs to be able to make at least 35 pips for me in order for me to take the trade. If it's anything less than 35, I'm just not interested. I take the criteria out. So if I measured from here to here, you can see from the bottom here to the top was 63 pips. So right here towards the watermark here is my take profit. Now let me just tell you a secret about that. I used to just put my take profits right at the water line all the time, and I noticed about 30% of the time that it would come within a pip or two and then just return and head the opposite direction. So after a couple of months ago, man, I just missed that. Man, I just missed that. Diane pointed out to me, hey, why don't you just move it? So actually what I do now is I put it about 5 pips below or above the water line, and it hits it every time. Now you could say, gosh, man, look at that. It ran up here. It ran almost 100, about 108 pips or 110 pips. I left money on the table. But you know what? Half the time, it's going to come, touch here, and move, and then you don't make any money. So like Steve teaches us, just be happy. If you can grab 50 a day off a couple of pairs, listen, it doesn't take a lot of standards. You put 10 or 15 or 20 standards on there, that's a great payday. You don't need a lot of pips. I mean, I can remember last summer grabbing 1,800 pips and thinking I was a hero. Just, that was a lot of work. And now, a couple hours, 2-3 hours a day, 3 or 4 days a week, it's just much easier. For those of you guys that want to stay up and trade the London, man, go for it. But those of you that have other things, families and different things, there's plenty to be made in the U.S. session. Let's look at another example here. Okay, so what happened here? Typical pattern here. 1, 2, 3 strikes for all my Asian and London friends. 3 strikes to the top. Came. Here's the M right here for our London guys, right? Here's the M. The entry's right here. Boom, dropped away. About 70, 100, a little over 100 pips here. Okay, but for us U.S. guys, where's the trade? Okay, it looks like some of the guys want the charts a little bigger. There we go. Okay. So again, here's the M pattern here. All our London traders are jumping in here. It comes down, bottoms out, retests down at the bottom for us U.S. guys. Let me just show you what that looks like. Marked up. Okay, a lot of people ask, and I'm seeing the questions here, there's 2 different ways you can enter this. One is you can enter on this candle here after it paints. You can enter right here. Anywhere in here if you want. For me, because I've been doing this long enough and I understand what's going on, I'm very confident that as soon as this thing turns, that's when I get in. I'm rarely ever wrong, but occasionally I am wrong. So there's two different ways you can enter. You can actually wait till this finishes painting, or you can actually take it when it turns. So right here I'm entering off the second leg, and again, what do we see down here? Is that a W pattern right there? Yes, it is. So where's our take profit? Take profit is 50 pips or the watermark. Bread and butter, guys, bread and butter. Just make it easy. We don't have to get fancy. Just make it easy. Now look at this. This almost went all the way to the male, and that would have added maybe another 30 pips. But you know what? Doesn't matter. Get good at making 50 every day. Here's our next example. Okay, we see it had some crazy activity out of the Asian session here. Kind of dropped down, came back up. Had a nice drop here. I'll see if there's a trade in this one. Okay, there's two ways to look at margin. And Steve, you can correct me if I'm wrong, but for me, I'm not that concerned with it. I mean, you can put some extra money in your account. It depends on how much money you want to make. If you're looking to make $1 million, then you need more money like Rick has in his account. But if you're looking to make 8, 10, 12 grand a week, you really don't need that much money. So what we're looking at here is it came down, bottomed out, rose up, and then it bottomed out again, and that's a typical W pattern or reversal pattern in the U.S. session. Guys, if you go back, you scroll back in the charts, you will see this over and over and over and over again. And it's easy money. And guess what? Easy money, 2-3 hours a day. Be up all night for 8 or 10 hours, or get some easy money during the day. That was a no-brainer for me. Okay, and where's our take profit? For me, it's either 50 pips or just shy of the watermark. Let me show you another example. Okay, Ross is asking if we have any favorite pairs. Ross, anybody that pays me is my favorite pair. I could care less who it is. I'm not impartial. I've studied them all. It doesn't matter to me. I'm simply looking for the behavior. If somebody's going to give me the behavior, they want to come to my playground, play with my ball, and behave, we're going to play ball. Here's the thing. A lot of people ask too, hey, what if it's not at level 2 or level 3 or goes 5 days up, 5 days down? Listen, if it doesn't do exactly what Steve has taught me to do, doesn't behave that way, I don't play with it. I don't even look at it. I don't care. Because you know what? There are so many pairs every day that are going to behave just like Steve taught. So it doesn't matter. I'm not, favoring one or the other. I'm favoring the guy that plays by the rules, that behaves. It's kind of like the kid that behaves. I like to play with the kid that behaves. The kid that doesn't behave, I don't play with him. Skip has a question, how lopsided of a W will you take? Doesn't really matter to me. As long as the second leg is a little bit higher or even equal to the first leg, I'm going to take it. If everything else matches up, I'm going to take it. Okay, here's a look at EJ. And this is classic textbook that Steve teaches here. I mean, this is a perfect picture. I'm going to frame it and put Steve's face on it. 1, 2, 3 swipes to the high, bounces off the male here, and fades away. Perfect setup for us US guys. Watch this. Drops down. Now, sometimes you're going to get a W, sometimes you're going to get a V, but look right here. There's a W here on TDI. It's stalled out right here. It couldn't break the low. Guess what? It's got nowhere to go but up. Hey guys, I'm not the brightest guy out there, but you know what? If you go back in the charts and you just look for these patterns over and over, you do the homework like we did, and just look at the sessions and look at their behaviors, you'll notice if you go look at the US dollar, Canadian dollar, 90% of the time that thing retests in the US session. Gives you a W like 80-90% of the time. You're going to understand these guys' behaviors and you're going to beat them. So here we go. Our entry is any one of these candidates. They give us 45 minutes to get in. 45 minutes. And then our exit for me is at the 50. You want to write it to the male? Go for it. I'd rather go out to lunch with my wife or go to Disney World. It's only 10 minutes from my house. That's funner. Okay, we got a few more examples here. I want to make sure you guys get this, so I'm going to show you about 5 or 6 more examples, and we'll wrap up here in about 6 or 7 minutes. Okay, Jeff's asking about when it's going to exceed the ADR. Jeff, let me show you exactly what I do. You're looking at a pair. Here's another textbook, Steve Morrow textbook picture right here. 3 swipes to the high, right? This box is less than 50 pips. 3 swipes, 1, 2, 3. Beautiful M, gives you a second chance to get in. If you didn't catch it here, it gives you a second chance right here, and the thing just flushes all the way down. Now here's what you're going to do. You're going to take your crosshair and you're going to put it on the top of this candle here, and you're going to run it all the way down to the bottom. This is what I do to every pair. I look at them, I measure it, and say, okay, you know what? This guy normally runs about 105, 110 pips a day. It's around 150. Guess what? It's very, very unlikely it's going to continue to drop. Because why? Like Steve teaches, there's parameters that these guys have that can't crush economies. So we know that. When this guy painted this beautiful railroad track, guys, that was a lay down, come and get me. Here's some money, man, for anybody that wants it. Our first take profit is right here. If you want to keep going, you can go here or just write it out. It's up to you. Let's take a look at it marked up. Is this starting to blend with any of you guys? Is it making any sense, or am I going too quick? Okay, Sean is asking, do I look at the candles this big when I trade? Sean, let me let you in on a secret. In our war room, we have, let me count them up. 1, 2, 3, 4, 5, 6. We have 8 27-inch screens, and then we have 1, 2, 3, and then we have 3 like 15-inch screens. It's much easier. I'm not saying you need to do this, but you know, a while back I was trading on smaller screens, and it was a lot harder to see. I went to the larger size screens. I have 27s like Steve, but a lot of people go to 24s. It is much easier, not a requirement, but it's much easier for you to see the patterns and to see the candles. Okay, so let's take a look at this one. Again, this is a Steve Morrow textbook setup, guys. This, you know, the way Steve trades, he's not in and out every night, guys. Steve's a stalker. He's a sniper, man. He hunts these guys. He waits for the perfect setup and then lays it away. Just lays it away. Steve probably waited a week for this setup, saw it, and crushed it. And that's how we need to be. If you're going to win, you got to be disciplined. You can't be trigger happy. You can't think you're going to trade every single day or you're going to lose. The longer, it's like a casino. The longer you're in the casino, the higher probability it is for you to lose. If you go right in, just like with this market, you know what you're looking for, you take your trade and you get out and you get on with your day. This particular setup, this was a V, bottomed out. This was outside, right? It's not really a shark fin, or it's actually a pretty ugly flat shark fin, but it's outside the volatility band right here. It gave us a couple of entries here, right? We got a railroad track, and then we got indecision candle, another one which pushed down, gave us another entry there, and then it took off. If you study the U.S. session, I'm telling you, you will see these patterns all the time. I know that Kim, Granny, Lauren, a bunch of our other friends are trading these, you know, this particular session. You do not have to do it exactly like we do it. I mean, you can take what Steve has taught you and kind of tweak it to your own personality. This just works really well for us. Now, I want to let you know I'm a little upset because this week we've been really busy, so I haven't been able to trade. There were some home runs today. I was upset when I was looking at this today, but you know what? Let me show it to you. Let's see here. Okay, this is kind of small. I'm not really liking the way this looks. But if you take a look at AJ this morning in the, let's see here. Is that any better there? Okay, excellent, excellent. Okay, so blown out session, right, in the Asian. So this is something our London traders would not look at. But it pushed to the upside here, right? Gave us an evening star and just I mean, just tanked right to the bottom. Those of you that are conservative, your entry is right here. Those that are real aggressive, I can tell you Steve probably caught this if he was up today right here because he's just a master. This is where I'm looking to grab it. When that candle turns, man, I know I got it. And it just took off. Let me see if we can find a couple more here. Okay, here's another pattern here. This was this morning, and this is the Euro-Aussie dollar. Kind of monkeyed around most of the day, but came down right off the Mayo here. I'm sorry, right off the water. Gave us a morning star and took off. Took off for 150, 60 pips. So for me, if it's a counter trend trade like this, for me, I'm looking at just a 50 pip take profit. How long did it take to hit that? If I got in here, in less than 45 minutes, man, I'm done. Let's see if I can find that. Yeah, you can also see, so let's click that up here. So you can see the morning star here. Take a look. Take a look what it did here on our TDI. Guys, that's a textbook right there. Yes, most of these trades are level 3. Those are, now to be honest with you, all my trades are not level 3, but those are the safest trades for people that are beginning to learn Steve's method. So that's what you need to look for. Until you master that, there's no reason for you to look at anything else. Okay, Jerry, I did not trade today because it's non-farm. But if I wasn't busy, you know what, sometimes I do, to be honest with you. But Steve's coached me up, he's coached you up, you know the rules if you're going to do it. There's time frames, certain time frames that you do it, and there's time frames that you don't. Okay, going to give a couple more sessions. Steve, if you could be ready in about 2 minutes, I'm going to do a couple more examples, and then I'm going to turn it back to you. Here's another nice setup from this morning. This is the Aussie Swissy. And you can see it was pretty ugly activity. But what was our key here? 2 different keys to enter this trade. What were they? I'll give it a second to load. Okay, correct. One key is the railroad tracks. Dak, you're getting it, man. The next was the shark fin. Exactly. So we have railroad tracks here, shark fin here. It's down near the 32, which tells us, guess what? It's time to roll. It's time to turn over. So take profit could have been here or up here. Okay, we're going to do one more. You know what? This was actually a great example. This was that same trade. After I really looked at this, I thought, gosh, there was some fantastic money that could have been made off this particular trade. What do we have here? What do we have here? That's right, we have a star right here, and it pinned to the Mayo. So what it did was, this is a trade signal here to get in. It's pretty close to the water line here. So, but generally speaking, when it pins off the Mayo, that's a sign of a reversal. So you could take this, dropped 159 pips, came back up, hit the water line, dropped back down, gave us another railroad track. What do we have down here? Exactly. That's a picture-perfect day right here. We could have taken it up here, wrote it down for about 150 pips. It bottomed out, came back, retested, bottom out, rode all the way back up to the top. I'll guarantee you if Steve was awake and he was looking at that, he would have crushed this one. Anyway, guys, I hope that helped. Go ahead and inside of the forum under the U.S. session, there's some tips that might help. If you have any specific questions, feel free to email me. I'll try to help you out that way. We hope to see everybody in Dallas. And definitely you'll be able to meet Diana. She's excited to come to Dallas. Steve, if you're available, it's back to you, my friend. Thanks for everything.
Okay, man, look, I could go on for weeks on end and just keep going, man, and teaching. I had so much stuff rattling around my head, but I can't confuse you guys and keep throwing stuff at you. So take a couple days off, give yourself a rest, try to make the Sunday breakout session. if you're struggling with the platform. And then try to make plans to get to Dallas. I'm trying to work out some way to, I mentioned you were trying to figure out some way to broadcast Dallas. I don't really know if that's going to happen, but maybe we'll do something with the recordings or something, put them back up. I'll figure it out, man. Just want what's best for you guys, but if you've done any research about me on the internet, my shit is everywhere, stolen, robbed, repeated. So I'm trying to keep a lid on some of it. So we'll figure something out, okay? Don't forget, if you're in need and you want to come, we're going to set up a raffle. I know Scott's working on some code for like a link to sign up. And we'll figure out a way to get everybody accommodated over there. If you want to come, just let us know. Don't wait till the last minute, because I got a plan for 100 or 500. I don't know how many people are coming. Okay, so as soon as you decide you're going to come to Dallas, shoot Zen an email. We start getting a head count and getting the venue lined up to handle everybody, okay? But everyone is welcome. Don't feel bad if we're coming or anything. I would love to have everybody over there. It'd be great. Have a good time. And we're going to eat some great Texas barbecue and hang out. All right. Don't be sad that the class is over. Like I said earlier, it's the beginning of our time together, the beginning of our journey. Spend some time in the forum. Give your head a break. Thank you, guys. Thank you. Everyone's saying beautiful things. All right. I always have to say this, so I'll say it one more time. I've said it earlier, but I'll say it again. Do not commingle with non-students. They are going to tell you that you are crazy. I've heard it for 10 years. They're going to tell you that there is no way that the people that are telling you the numbers they're producing are producing those numbers. Rick is not a liar. Abo is not a liar. Zen is not a liar. I am not a liar. Once you know how these guys trade, you truly can beat them and make a living for yourself in the markets. My hope is for everyone to start making 6 figures a year and beyond. If you're struggling, I want to know about it. Send me an email. Let me know what's going on with you. We'll work through it. Stay within the group. Go into the forum. There's some fantastic traders in there. Jim, Gary, Scott, they're in there. Carr's in there. They're in the forum posting their trades. Don't be embarrassed to post. Don't sit on your hands for 2 or 3 weeks and not post any of your trades up. If you're soft-skinned, they might rip you a little bit because you took something for a certain reason. Look, get over it. You're going to learn by putting your trades up there and letting people critique it. Okay? I want to thank all of you for believing in me and trusting me with your hard-earned money. It means a lot to me. It's a responsibility I take seriously. I want you to have success in this business. You deserve it. And when you do, I want you to pay it forward somehow. Share it with your children. Maybe bring your spouse in with us. She probably thinks you're crazy. It's a fantastic group and a family and a good place to be. I'm looking forward to seeing everybody in Dallas. Thank you for your week and your time. Thanks for your Friday night. See you guys again. Good night.